Risk and perhaps positive peace dividend coming in the Black Sea showing up in those shipping stocks.
Yeah, we continue to watch any read across from that Black Sea arrangement, the Black Sea details as they become clearer and clearer. Perhaps they will have an impact. Let's have a look at where we open up these markets then. We're waiting for later today to hear from the UK Chancellor Critti. So from a UK perspective, perhaps that's something that is a big calendar item at least that we will focus in on. The spring statement coming later from the Chancellor here in the UK. But other markets around Europe not waiting for that kind of news flow. And the Stoxx 600 is pretty flat. The FTSE 100 up by 0.2%. So we're seeing a little bit of that modest positivity coming through this morning. We'll keep an eye, as you said, on those mining names, on anything to do with the commodity-related trade. Yesterday, we saw some tentative movement in some of the fertilizer stocks, some of the soft commodities, some of the oil and gas news flow surrounding the Black Sea. So it's starting to get through into the market thinking, but we'll see if there's any more to run on that particular agenda. The DAX is up by 0.4%. The CAC 40 up by 0.2. The IBEX, though, pretty flat this morning. Critti, do you see anything more interesting beneath the hood? A sort of modestly positive start to trade this morning.
Modestly positive is absolutely the right way to put it in terms of some of these moves. A lot of this is driven by a lot of the kind of energy space that we were talking about in the commodity space as well. Mixed bag when you look at the sector picture, though. On the back foot is your healthcare, telecom, travel, and leisure. But your outperformer this morning from an index contribution perspective, Shell is at the top of the list. And a lot of that has to do with the strategy that they've been talking to Bloomberg about, as well as some of the other media outlets as well. Tech is also back on the front foot. Schneider Electric, ASML. So these are two sectors that don't often move together, tech and energy, and yet that's what's driving the trade this morning.
Yes, and basic resources does seem to be another sector that's providing some upside this morning. The best performing sector this morning for European equity markets, up by 0.7%. Anglo-American is one of those. Glencore, Rio Tinto also higher, and I think Joe Easton was telling us a little bit about some of the sector news flow there. Let's have a quick look at what's going on with gilt markets, because we're seeing gilts gaining after that UK CPI print. It came in weaker than had been anticipated. Does it make it easier for the Bank of England to cut rates? The view of our guest was not necessarily, because inflation will pick up again later on in the year. And also he was flagging the stickiness of services inflation. But for what it's worth, we do see those yields moving this morning down around, 3-4 basis points on UK gilts this morning.
Absolutely, and we're going to see how much of that shakes out or how much of that changes, of course, as we get closer and closer to that spring statement off the back of the CPI numbers. Let's bring in a markets guest here who, of course, can have a little bit more analysis on how to interpret the world at play. Obi Ijikimi, fund manager over at the global equities team at Carmignac, joins us around the table. It'll be a pleasure to have you on this program. We keep kind of waiting to see how some of these geopolitical stories, the tariff stories, are going to shape the equity market. What is the smartest thing to do right now? To sit on the sidelines and wait for the impact, or to trade it ahead of time?
Morning again. I think sitting on the sidelines is a risky strategy. I mean, there's as a result of what's happened that we've seen this year already, there's been a lot of stocks that actually have very, very little to do with the geopolitics that have had quite severe corrections for various different reasons, which we can come on to. So I think sitting on the sidelines will mean that you'll miss out on those opportunities. Geopolitics has been an issue for many, many years. There's always something. I remember in 2023, 2022, there was always something that you need to be worried about. Now, as an equity investor, I think you need to look through those and stay invested and look for the opportunities in stocks that will be able to weather the storm and survive and be here in the years to come.
It kind of sounds like there's a hedging strategy at play. Where's the best place in the market to do that?
Well, I think in terms of hedging, I think just look for the areas of the market that you like over the long term. I mean, some of the names that we've been adding to recently in some sectors which really, like I said, are not really linked to it. In the technology space, for example, especially in some of the mega cap US space, where really the geopolitical noise is not going to have a significant disruption. I mean, look for areas where there's been stocks that have been hit by sentiment just deteriorating. So, for us right now, we're looking in the US in particular. I know the stories about Europe, and we all want to look for opportunities in Europe. But in the US, you've had a sizable correction in some of the long-term winners, and that's part of the market that I think looks quite interesting at the moment.
Yeah, Obi, good morning. It's interesting. You've been adding to your positions in some of those big US tech names. So the tech names themselves and some of the AI proxies. I suppose it's interesting to hear your arguments as to why you do that, because if you still believe in them, then why not? But some of the fears have been around rivalry from Chinese startups, for example, DeepSeek, and other fears have been around maybe inflated expectations of just how much capex some of these big US tech names are going to do, and therefore how much of how much growth they're going to see in AI. So why do you have so much more confidence maybe than some in the market around those tech themes?
Well, I think, first of all, we're long-term investors. And so if you're thinking over 3 to 5 years, then it's very rare that you get dips in great businesses that you're investing in for the long term. The second part is just the valuations of some of these stocks now. We were worried at the beginning of the year that they were expensive. And I think there was a valid argument for that. They came off the back of a phenomenal growth rate, 35% earnings growth last year. And expectations were dropping to 25% for this year for those type of companies. Now, that's a big drop, and so therefore the valuations needed to come down. And I think we just had that. So if you had a valuation reset, now we start to grow from a new base, and that's an opportunity to buy in as an investor. And then I just think that broadly sentiment, if you look at retail investor sentiment, we have a great index that we look at, which is the American Association of Individual Investors, and it tells you whether they're bullish or they're bearish. And we hit lows in the last 2 or 3 weeks that we've not seen since 2022, which was a phenomenal opportunity to buy back into these stocks. So sentiment plus the long-term thinking in these stocks and valuations, which are now not as expensive as they were at the start of the year, creates an interesting opportunity.
What do you make, Obi, what do you make of the US consumer weakness that we've seen certainly in the survey data, not necessarily in the hard data, but in survey data? This seemed to be something that the market managed to look through yesterday. But for some people, this is cause for concern, a 12-year low on consumer expectations in the States. Now, I'm not suggesting that should influence the amount of data centers that some of these big hyperscalers build. There isn't that connection there necessarily. But what kind of downweight can this consumer spending story apply to the US tech sector, or is it going to be immune?
I think it's going to be relatively immune, but I think it's important just to make a broader assessment of what's been going on. If you take the US and look at profits growth over the last couple of years, it's been pretty anemic. So if you take out the best companies, what I think people would refer to as the Magnificent Seven, and basically there's been almost no growth last year and almost no growth in terms of earnings the year before. And so that environment it puts you at risk if things start to go wrong. And I think the consumer is reflecting that. No growth, therefore, if things start to go wrong and the margin sentiment deteriorates a lot faster. But actually, if you add all these things together, very weak consumer sentiment, very weak retail sentiment, very significant geopolitical uncertainty and policy uncertainty in the US, people are very, very fearful today. And when you have that amount of fear, as an investor, you have to start to think about the contrarian side of it. It's not to be gung-ho and be too risky, but actually, on the margin, you don't get these opportunities very often where people are so negative that the net new move forward was probably going to be more positive than that.
You use the word margin. I'm going to put it in a different context, though. Talk to us a little bit about pricing power here. If we're talking about this era of caution, we saw it in the data as well. Anna mentioned the consumer confidence numbers in the States as well. Does that limit companies' pricing power, and does that limit some of the kind of costs that they can pass on, which in turn limits the margins, the EPS, et cetera? Is that what you're seeing?
Yeah, Kriti, but that's not new. That's been going on for some time, and that's where we invented the phrase the Magnificent Seven in the first place. They are the very few companies, and we don't invest in all of them, but we have significant exposure to some of them. But that's where you have companies that have been able to grow their revenues and their top line by over 15% on an annual basis. That's very, very difficult to do, and that's where most companies are struggling. Difficult to grow their revenues, and as a result, difficult to grow their profits. And so that's not a new story, and I think that's going to be a continuing trend, especially as we start to deal with the impact of tariffs and so on. So, yeah, it's a bit more of the same to me than it has been anything different.
And maybe where are you looking in Europe? So that's your US enthusiasm, and we understand that's from a long-term perspective. Where does that same long-term perspective take you in Europe then? Because we've seen this, according to Mario Draghi, game-changing resets in policy from Germany. So what does that add up to? What opportunity does that add up to for you?
Well, I think in Europe it's now becoming more challenging because, first of all, we had a significant rally in European stocks year to date on the hope that we're going to see some of the stimulus, and I'm sure some of it will come through. And so when you hit the valuations that we're now seeing on Europe, if you take the stocks, Euro Stoxx 50, for example, it's now trading at the highest valuation that it has done in the last 10 years, if you strip out that sort of COVID era, which was a bit of an exception. So you're not buying into a market that's particularly cheap. So I think that the next trade for Europe is to buy into stocks which have the earnings story and the earnings momentum story. And that's where we still like the long-term compounding. And our fund is called the Carmignac Global Equity Compounders. Mm-hmm. So we like the compounding, snappy. We like the compounding stories. So we like the names like Novo Nordisk. Again, another stock which has been had a bit of a derating on growth fears, but we like it over the long term. Schneider Electric. So there are names, but we tend to prefer to be in the spaces where we can have a good, decent 3 to 5 year story, as opposed to trying to chase the shorter term.
Yeah, so Europe's
stories.
Not cheap anymore. This is new.
This is new, but so much of that, it feels like, when you look at it from a valuation perspective, has been driven by buybacks, dividends, kind of this capital return, which the critics of that argument would say has inflated these valuations. Where do you stand on that?
Look, I think in Europe, I think it's just a case of a re-rating story, and that's really been it. I mean, when you have everybody positioned in the US at the start of the year, we were on the back of this sort of US exceptionalism, and you had the money flow into Europe, it's pushed the valuation of the market up, and earnings really haven't gone up, and that's where we're going to have a test over the next 2 to 3 quarters, is whether or not the companies can deliver on now the higher multiple that Europe's trading on. So I think it's more of just the optimism in Europe has seen a big flow of money into it, rather than anything specific from a fundamental perspective.
I mean, the global rotation has been, I think it's fair to say, historic at this point. Obi Ejikeme, fund manager over at the Global Equities team at Carmignac, giving us his analysis this morning. Let's get a quick check on the core 6 here. Of course, the biggest heavyweights that may not be moving the trade. A lot of it is focused on the tech space. Take a look at ASML, Schneider Electric. They are your 2 outperformers this morning, your 2 biggest index contributors to the Stock 600. Schneider Electric really taking the cake the last couple of days, moving the entire French market as well, higher by 0.6%. But on the back foot, and I feel like I say this quite often, Novo Nordisk down by about 1.4%, and LVMH as well, perhaps paring back, at least on the LVMH front, the outperformance in yesterday's session. That is your core 6. Going to check some of the other individual stocks on the move with Joe Easton. Joe.
So we're seeing a big move in CD Projekt over in Poland today. This is the games maker over in Warsaw, hit after another delay to its Witcher game that has been flagged by analysts recently, saying they were worried that could see a delay. And that's what we're seeing, more delays in terms of a few more months until that hits the shelves, and that is hitting the stock this morning. So we're down 8%. That's the worst performer on the Stock 600 for CD Projekt. Then in terms of Prysmian, that one looked a little bit stronger. The company doing some M&A over in the US, expanding its footprint as it builds out more energy supplies for data centers, all tied to the AI trend. Of course, that one up 2.3% in Italy, and some positive trading numbers coming out of their CMD as well. So a good one for the Italian sector. Then in terms of your ready meals, frozen lasagnas, we've got M&A in that sector, of course. Bakkavor getting that takeover bid potentially going to be increased in terms of the offer price coming from Greencore. Bakkavor supplies to Tesco, so up 6%, a decent move. That one has rallied over the past few weeks on the speculation of that deal coming through. Then a big decliner in the UK at the open was at Vistry. We're down 7.5% on that one. Now, weak trading update out of the UK home builder. Once again, they've had a couple of profit warnings, and also we've had that UK inflation number as well, of course, and as well Rachel Reeves giving her statement later today. A lot of focus on the UK market and particularly home builders. If we do see any more movement in the gilt yields this morning, do keep an eye on home builders. But Vistry, the worst performer, given a weak trading update from the company. Now take a look at Ocado, up 12% this morning on an upgrade from JP Morgan. They say they are about to see the turn in the tide for Ocado on both their retail sales and also their sales of robotic warehouses to other grocers. That's going to potentially start boosting the company, according to JPM. They go overweight in the stock. I can't believe that price up 11% at the moment following the JP Morgan upgrade really powerful in terms of that rating change this morning. And another one I liked was Intesa Sanpaolo upgraded Adexane, BNP Paribas. This is because of the Italian banking M&A, and they think Intesa is going to be the next one to benefit from that. UniCredit is their top pick, but they also like Intesa. Comes up and the stock is rising 1% as it goes to outperform Intesa Sanpaolo gaining in Italy this morning.
Joe Easton from our equities team walking us through some of those early movers. We thank you so much. And of course, it is still a change in daylight savings, which means the U.S. pre-market has also opened. 3 stocks you definitely want to keep on your radar. And I want to point out to you, let's start off with Tesla here. In the pre-market, down about 1.8%. It saw a big move to the upside to the tune of over 20% in the last couple of days, also paring back its massive drop year to date as well. It looks like it is back in the red this morning, down about 1.7%. NVIDIA as well, seeing a drop in their China sales. That perhaps weighing on the stock in the pre-market, down by about 0.7%. But the copper story lives on. It is boosting Freeport-McMoRan, seeing the most volume this morning in the U.S. session to the tune of 1.4%.
Okay, coming up on the program, we focus in on commodities. Shell bets big on natural gas. We'll bring you an interview with the energy company's CEO. That is coming up next. This is Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the centre of all the action to get you set up with the numbers, news and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything. Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Bringing you up-to-the-minute financial and geopolitical news whenever and wherever it happens. I'm Francine Lacroix in Davos, Switzerland, and this is Bloomberg.
Welcome back to the opening trade. We're 18 minutes into today's session. Seeing a lot of those opening gains pared back when it comes to the European session. I'm looking at the Euro Stoxx 50 down about 0.2%, broadening out to the 600, also down by about the same margin. A similar story across the board. Some slight outperformance in the FTSE 100. They could be responding to the positivity you're seeing in the oil and mining space. But Anna, a complete turnaround just 20 minutes into the session.
Yes, indeed. Let's talk about the commodity markets, because there we're seeing some volatility as well. Shell CEO Wael Sawan has warned investors that pursuing major deals could serve as a distraction. He also spoke to Bloomberg about the company's move to put LNG at the heart of its 10-year strategy.
We're very proud of where we are today. Today in the Capital Markets Day, we took a pause and reflected on the journey we've been on over the past couple of years. And the key message was one of trying to instill confidence. Here's a company that has delivered what it said it was going to do and actually over-delivered in certain areas. And beyond that, as you rightly pointed out, we've also today laid out a vision out to 2035 that has LNG at the heart of it. We believe LNG is going to be a critical part of the energy system, and we want to be the leading player in LNG. But our story also has lots of richness around wanting to sustain material liquids production and being the most competitive and the most focused energy marketer and energy trader in the world. And so a holistic story that I think we're very proud to be able to say is well on track.
Are you worried at all about a potential looming LNG supply glut and kind of betting really big on this for the next 10 years at a time where there's just too much supply coming online?
Look, in my job, I have to look at 20 years. And what I see when I do that is up to 2040, we see a potential 60% increase in overall LNG demand. We have a diversified portfolio, both of production sources as well as demand options. And we are very much looking to leverage that global diversity of production and customer contracts to be able to create value. Importantly, our LNG portfolio is heavily linked to long-term contracts that are tied to Brent, which means we have a lot of resilience. And so we can ride out the inevitable cycles in this business while making sure that the underlying cash flow continues to come from this business.
So what should investors look for in terms of the capacity increase on your LNG output?
Very much what we outlined today, which is 4 to 5% per year. So indeed, the 20 to 30% by 2030, and that's just to 2030. We see more running room beyond that. We have projects that we can evolve over and above that. But what's unique around our LNG business is not just the production piece. We are actually also selling roughly the equivalent amount, not just of what we produce, but also another equivalent amount to that, because we're also one of the largest optimizers of LNG in the market. And so in any year, we're selling around 60 million tons of LNG, which is significant. And so we are trying to continue to build up our portfolio to really have that diversity and to be able to make sure that we can continue to essentially stay in the 15 to 20% of the overall LNG market is what we represent.
That was the Shell CEO, Wael Sawan, speaking to the Bloomberg team, talking about the company's LNG push. We will circle back to that story in just a moment, because let's focus on other matters to do with commodities. Oil, wheat and corn futures have been on the move after Russia and Ukraine agreed to a ceasefire in the Black Sea in talks alongside the United States. Some of the key details perhaps missing, but Black Sea ports are major hubs for grain and fertilizer exports. Washington says the agreements will also ensure Russian access to these goods. Joining us now, Bloomberg Senior Executive Editor for Energy and Commodities, Will Kennedy. Will, good morning to you. There's a lot in the mix today when it comes to the commodities space. Let's start with some of these soft commodities and how they might move on the back of the news lines we've had on Russia, Ukraine. It did seem as if the Russians are saying we will agree to this Black Sea ceasefire as long as we get sanctions lifted on SWIFT, for example. The US pledging to help them in some ways with some of that. But does that leave things clear for commodities traders about what this means for commodities or not?
No, I think things are quite unclear, and you see that, and there hasn't been a massive price reaction. The situation in the Black Sea has been volatile over the course of the war, and there was a time when it had really constricted exports of grain from Ukraine in particular. Things are flowing. I think if you got this ceasefire and it did prove to be sustained, what it would do would reduce costs markedly for those exports, i.e. insuring those ships, the cost of hiring those ships would come down, and it would make trade easier. It wouldn't mean a huge amount of flow into the market, because most Russian and a lot of Ukrainian grain has been finding its way into global markets.
talk to us a little bit about the impact perhaps on the shipping costs then when it comes to the Black Sea. If it doesn't show up directly in the commodity market, does it show up in the transport around the commodity market?
Yeah, I think that's where the biggest impact would be, because right now a lot of ship owners don't want to go into the Black Sea. It's still risky. There were some incidents around mines earlier on in the war, and they still have to pay very high insurance costs. So it would definitely bring down shipping costs in the region, which ultimately would feed through into the final price that people pay for wheat exports from Ukraine and Russia, and it is the most important source of wheat exports to the global market.
Okay, so that's the Ukraine story. As much as we know right now, wait for further details. We're also waiting for any detail around tariffs as it pertains to commodities. And copper seems to be the thing that has caught everybody's attention. It's a real hot mess, was the words on the Markets Live blog earlier on, because of this big gap that's opening up now between US pricing of copper and the LME price. Where is this heading then, Will?
Yeah, I mean, this is a market where you've seen real dislocation as traders are having to speculate about the tariff to come. I think that President Trump has made clear that following on from tariffs which are in place on aluminium and steel imports, he does want to see those tariffs on copper. The really important question for the market is when. We've seen traders move many, many thousands of tons of copper from outside the US into the US market, and then that's produced this spread, as you described, between US copper prices, which are trading at a record, and London prices, which are significant discounts. So you've got this transatlantic arbitrage. The real question now is, if those sanctions come in much quicker than people have expected, will some of that metal be stranded? Will traders be faced with metal on the water that hasn't made it to the US in time? So that's why people are describing a messy situation, and the all-important question is exactly when those tariffs would come in. Our reporting says it might be sooner rather than later.
Does it have anything to do in terms of the ripple effects here? I mean, I thought it was interesting that he targeted copper tariffs, given that Chile is the biggest producer and China's the biggest consumer. So how does this feed back into perhaps his broader agenda?
Well, I think it's all about reindustrializing in the US. There are copper projects in the US. There's a big mine in Arizona that's taken many years to get going, and I think he would love to see built, and it would give some impetus, presumably, to copper production inside the United States. He seems very focused on this idea of strategic minerals, critical minerals, no matter how you want to describe it. And I think he would like to have more copper produced in the United States. But I think there are some problems in the policy, as you point out, Kriti.
Well, we just heard from the Shell CEO talking about how pursuing any major deals would be a risk, a bit of a distraction right now. I mean, this is a business that knows something about major deals. If you cast your minds back, less than 10 years, I think, and there was a huge deal that was a real big bet on gas. So, I mean, they've done big deals already.
Yeah. And in fact, that big deal laid the foundations for the strategy that we heard Weil describe there, which was LNG. That LNG business was built partly on the successful acquisition of BG, another UK company, about 10 years ago, as you say. Of course, we asked the question because of BP. BP is not the favourite company among investors. It had this strategy reset under pressure from the activist Elliott, and investors aren't loving what they see there. So that's led to some inevitable speculation that we could create Shell BP, this giant UK oil major. Who knows? I'm not going to speculate on that, but clearly these are the decisions that Weil Sarwan is having to make. If there's a criticism to make of his strategy, which was warmly received, it's that there isn't that much investment, that much growth. So where's that going to come from?
Certainly something we're going to be keeping an eye on. Bloomberg's Will Kennedy walking us through the various commodity stories that are in the market this morning. Coming up next, we're going to switch focus from the energy sector to the banking sector. That conversation next. This is Bloomberg.
In case you missed it on the China show.
Compared to a 10% tariff on Chinese exports to the United States, I mean, even the entire determination of the fentanyl industry in China is totally worth it.
I think this is a monumental moment for global AI development. DeepSeek was not only just make the products free, but also they released the entire research open source so you can see how they did it. This has forever democratized this current most advanced version of AI.
How do your students feel about their jobs prospects?
There are a lot of opportunities in this AI application fields. On the other hand, if you look at traditional manufacturing, I think the main problem is that there's a lot of mismatches between supply and demand.
Don't miss the China Show live every weekday.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern, only on Bloomberg. Context changes everything.
This is the opening trade. We're 30 minutes into the European session, seeing red on the screen in most geographies, perhaps taking a little bit of breather, perhaps a little bit of caution. The stock 600 down about 0.3%. I'm looking at a CAC 40 that is also down by about the same margin. The FTSE 100, the sole outperformer, but not by much, only higher by 0.1%. The mining story perhaps working in its favor. Let's shift our focus, though, a little bit to the banking sector as well. Sources say UBS is offering to limit the future size of the investment bank and hold more capital in a bid to ward off stricter regulations. It's the latest move in the long-running back and forth between the banking giant and Swiss regulator FINMA. Joining us now for more on this, Bloomberg European finance and regulation reporter Nicholas Comfort joins the program. Nick, we know this has been an ongoing conversation in terms of capital requirements across Europe, not just in Switzerland, largely when we're seeing the United States deregulate, when we're seeing the United States capital requirements come down as well. How much of an impact does this make in terms of UBS and I'll say broader Europe's competitiveness with the U.S. based solely on this conversation?
Yeah, I think so. Clearly, this is really a Swiss story, Swiss exceptionalism in this case, because, I mean, as you see other jurisdictions sort of speaking about deregulation or in the European Union simplification, the Swiss are going another way. They're ramping up capital requirements on UBS. It's got some investors worried, that's true, and the lobbying is pretty intense in Switzerland. We have UBS saying that they would be thinking about a move to a different jurisdiction, or at least sort of intimating that to us in the press. And so that's really a question of, in this hot phase of these capital requirements which are being debated, which we expect to be coming to Swiss Parliament in May, we're really in the phase where the knives are out, and UBS is really trying to push back as hard as it can, arguing that it would indeed become less competitive versus other banks in other jurisdictions.
Yes, and Nick, part of that argument then, or part of the concession they're prepared to make to avoid some wider controls perhaps from FINMA, according to our reporting this morning, talking to people familiar with the matter then, UBS executives have suggested that a permanent cap on the size of the investment bank could actually be written into Swiss law. This sounds like quite an exceptional move. Is that going to move the conversation on, do we think, in Switzerland?
It could well. I mean, I think sort of we've got these two positions which are really diametrically opposed. The regulator on the one side willing to make very little movement in terms of its plans, only willing to phase it in slowly, the impact of the capital requirements. And then UBS coming out with something which I got to say, to me, sounds pretty similar to what they have been communicating to investors already, saying sort of, well, like our investment bank is only one part of our business, and there's a limit on the size of it. This limit would be more rigorous than the one which we've seen previously. But honestly, it doesn't seem like neither the regulator nor UBS in this particular piece of news has really made a big step here in terms of willing to compromise. So for me, these are still the opening skirmishes between them, and we probably will see some kind of a compromise, but it's gonna need people to really jump over their shadows, as you say in German, to try and find something which is more acceptable to the other side.
German always has some good ways of some more words. We need more words in English. Jumping over shadows. We can introduce that one. Bloomberg's Nick Comfort. Thank you very much for the update there on UBS. Let's stick with the UBS theme and broaden the conversation to the wider banking sector. Jackie Inniker joins us, CIO at Spring Investments. Jackie, nice to speak to you. So it seems as if, Nick's view there, we're still in this sort of opening stages of a standoff between UBS and the regulator. This latest suggestion from UBS that they would actually submit to having the size of their investment bank written into Swiss law, which seems quite incredible. I mean, where do you see this decision making around UBS heading? Because they've threatened to leave. Some say that's not realistic.
I think we've got years to go on it. I mean, if you look at what's going through Parliament, that's going to be in a couple of years. There'll be a referendum. I'm Swiss, so I'm going to vote on it. But in May, so we've got proposals in May coming, but they're on the small part of the capital requirements. They're on the DTAs. They're on the software intangibles. The really juicy parts are going to come not before 2027. There's going to be a proposal, and then probably 2028 is probably going to be a referendum. So it's a long way we've got, and there's no incentive for UBS management to underplay, how important this is. So I think, we're going to get more and more of this as the months go by.
So UBS will keep threatening to leave to try and get a better favourable environment, perhaps.
Yeah.
But I mean, and the regulatory environment globally perhaps plays to their favour, because they can point to the United States and say, look, America is regulating less, not more.
Yeah, they can. And when you look at UBS in terms of their equity ratios now, they're pretty much in the pack. They're not lower than, their big peers. So I think it's more about how you allocate that capital. The big story is about the treatment of capital for the foreign subsidiaries. And that's going to be an art, not a science. And when you think about double leverage and what the big banks do with that, I think there's lots of ways that this can go, but I think it's going to take a couple of years. That's the thing.
So there's deregulation and then there's simplification. Jackie, I just want to play you a piece of sound that we had in the interview with the Bank of Spain governor, who also serves in a banking supervisory authority. I asked him this very question on whether or not these banking capital rules are necessary. Take a listen to what he had to say.
Simplification doesn't mean by any means lower capital or deregulation.
But even to delay the Basel III requirements, to compete with the U.S.
I think Europe should not do that. I think Europe should stick to the path and that we have decided ourselves, and we should not be pushed by the decision in other jurisdictions, by no means.
So an ECB policymaker, they're making the argument that deregulation is not the answer, simplification of the rules, that these capital requirements is not going to hinder its competitive nature. But this word simplification has come up quite a bit, from banking CEOs to policymakers. What does that actually mean?
Well, I think it's what the UK is doing now. Since Brexit, I think they used the phrase removing unnecessary hurdles. Simplification, really. So I think that's a good thing, simplification, maybe for the smaller banks, which is exactly what the UK is looking at. But honestly, you mentioned deregulation. I'm not sure we're going to get deregulation. I think we're going to get a stop in further regulation in the US. And is that a good thing for the big banks? Yeah, I think it's okay, but they're already very well regulated, just different from Europe. We cannot get a single level playing field. It's impossible. We do it differently, Europe and the US, but both work. I think where the problem for me comes, and I focus on European bank debt, is for the smaller US banks. You know, the big US banks are very well regulated, but in Europe we apply our regulations really down to some of the smallest banks. In the US they don't do that. I think that's where regulation is needed, but you know, from our perspective, I'm not too worried about that. We focus on the debt of the larger banks.
And we kind of saw that with the SVB kind of regional banking crisis as well. That was a great example. But one of the big questions around simplification, specifically for the banking finance, has been in the context of defense spending, right? This massive 500 billion euros that have been unleashed in the markets. There's questions around the red tape in terms of putting up collateral for some of the banks for the defense spending. How easy is it for the European banks to participate in this fiscal boom?
My view would be it's very easy. I think there'll be ways to do it. You have to have banks to move the economy forward. You have to create ways to allow them to do their job, which is to support the economy and support the economy's growth. So, you know, if there are hurdles here, they will be simplified. And again, you've kind of seen that in the UK already. It's been happening fairly slowly, but I think the UK clearly has more leeway. There's not, 26, 27 countries who have to, agree on this.
Jackie, you say you focus on European banks, specifically their debt, but European banks. So let's look to the European space. I'm looking at, actually, on the stock side of things, European banks are the best performing sector year to date in Europe, so up by 27, 28%. And part of that is to do with that fiscal boom and what that does to Europe. Part of that is, well, maybe that also means that we don't get rate cuts in Europe. What are you assuming about that rate cut environment in Europe?
Yeah, on the rate cuts, I mean, obviously it's more in question, but, our view at Spring is that, we will still see rate cuts here. I think that can be both good and bad for European banks. I mean, good deposits, the cost of deposit goes down, fee income gets bigger. I think one key impact as well is that for rate-sensitive banking sectors like Italy, you'll see them look to, deploy capital elsewhere, maybe in M&A, maybe more share buybacks, because they need to boost that EPS to keep boosting it, let's say. And so for them, for the rate-sensitive banks, continued rate cuts are actually, relatively negative, but there's other stuff that they're forced into doing.
You know what I find fascinating is the biggest banks that are engaging in M&A are also the ones that have the biggest buybacks. So you see it in UniCredit, you see it in BBVA, you see it in others as well that have that kind of M&A inclination. Do they run out of money at some point?
Well, no, because the supervisors won't let them. That's the thing. You see, if you're UniCredit and you want to do, I'll throw it out there, like a 10 billion share buyback, they've got nearly 16% equity ratio.
Yeah.
What's okay is 12 or 13. I mean, I'm a credit analyst, even I'm saying that, a lower equity ratio is fine. So if you're UniCredit and you want to get to 12% immediately, which is not their target, you go to the ECB, you say, can I do a 10 billion buyback? You've seen what's happening in Switzerland. They're not going to say, yeah, go on, go for it, do that next month and let's see how it goes. They're going to say, do it slowly, do it over time. They're generating so many profits, they almost can't catch up with themselves.
Yeah.
But one other thing they can do, apart from share buybacks, is acquisitions, and obviously that's what you're seeing happening.
Well, it's just fascinating because it usually happens one or the other. You don't see them at the same time necessarily, but this is a different environment. Exactly. Jackie Ineke, pleasure to have you on the program, CIO of Spring Investments. We thank you so much. Coming up on the program, we're going to go right back to, I think, the main agenda topic of the day, which is, of course, what's happening right here in the UK. Chancellor Rachel Reeves expected to slash spending when she delivers her spring statement later today. We're live at Westminster next with the Treasury Select Committee Chair and Labour MP Meg Hillier. This is Bloomberg.
what legacy I would love to leave is to make sure that in my village I have infrastructure. So long when I'm gone, things are still working. Then I have done my job. And if some people get inspired through my work and then try to engage themselves for their community and create something that is inspiring for everyone, I will be happy.
What's the best piece of advice you would give to someone young who wants to make a difference actually in this world? In architecture or with something else?
Wow. I'm not the right one to just do that.
I think you are.
Yeah, but with the pressure you have, and then you try to be the good one, the fancy guy, the intellectual one, I have no advice than to believe in yourself and really work hard. You know, when I started, no one would have imagined that I will be able to see my name connected with Aga Khan or Pritzker or sitting at Bloomberg to talk about sustainability, about future of sales. No. Myself, 5 years ago, if you told me that, I will say no. I will never imagine. So I will encourage everyone to believe in what you're doing and not try to run after the newest of the newest. Just be consistent. Just work on things that matters for you. Really, at the long term, it pays.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
The overall message needs to be a bit of a reset, frankly. The government didn't get off to the best of starts, although it had a lot of goodwill, and it inherited problems. But the result is at summits like this, on the other side of the world, there's quite a negative sentiment about the UK, and that needs to be changed.
Trying to reset the conversation then globally. Former UK Chancellor George Osborne speaking to Bloomberg on the sidelines of the HSBC Global Investment Summit. I mean, Chancellor a very long time ago. Now, you know, big in the museum world is where he resides. We've had UK data out this morning, Chrissy. We got the CPI number. It came in soft. The pound dropped. But does that mean anything for the Bank of England's ability to cut rates? We got some interesting perspective on that from Lawrence Mutkin, saying, just as Lizzie did, that we are going to see a pickup in inflation later on in the year, so maybe that means the Bank of England can't cut rates quite so readily, and also flagging this services CPI number that came in at 5%, and that has been something that the Bank of England has sort of attached its focus to when it comes to just how sticky inflation is in the UK.
And they're now pricing in an 80% chance of a cut in May, something we spoke to Lawrence Mutkin about, and saying the likelihood of that is still up in the air when it comes to that.
Yeah. Dan Hansen joins us, Bloomberg's chief UK economist. He can weigh in on this inflation point. Before we get to the spring statement then, Dan, on the inflation side of things, yes, we were having this debate earlier, you know, weaker inflation. Well, does that mean the Bank of England is more likely to cut rates? The market move in that direction, but it's not a 100% chance for May, is it? And yet we still have this sticky services print on inflation.
Yeah.
What were your takeaways?
Yeah, I mean, the market is focused squarely on the headline surprise. Everyone was expecting 3. We got 2.8. If you dig beneath the surface, though, I think you're absolutely right to highlight the point about services inflation. And if you go back to the minutes of the meeting last week, Bank of England's meeting last week, they were highlighting this idea about sticky underlying inflation, and by that they mean sticky services inflation. And if you look at the data today, it's sticky. You know, it's not moving down. And I think they probably will cut in May, but our forecast is for a quarterly path of cuts. I think in the second half of the year, that's becoming we're a little bit worried about that now, that they might pause.
Because inflation might go up again.
First of all, because headline inflation is going to go up. That has implications for inflation expectations. And second of all, because of this services inflation point, it's sticky.
So what can Rachel Reeves say today to make everyone feel better?
I think she's going to say a few things. So first of all,
is that where the bar is, by the way?
Yeah, I think comfort is yeah. Go ahead, Dan.
No, thanks. So the first thing is, and the key message is, the world has changed, and we all know that, and that's going to be the sort of how she's going to frame, if you like, this what she's going to announce.
And that means higher rates, just to turn that into financial lingo. Yes, the world's changed, but...
Yeah, it means higher interest rates, it means higher defence spending.
Yes, okay.
It's two things, both of which obviously mean more difficult fiscal choices elsewhere.
Yeah.
So we're going to be hearing about that, the fact that we're going to have deeper spending cuts here in the UK in order to meet the fiscal targets, create headroom against the fiscal rules. I'm going to be really interested to hear what the OBR has to say about the near-term outlook, but also the medium-term outlook. I think the takeaway, the likely takeaway at least, although these things we can always get surprised, is that a lot of the tougher decisions are going to be delayed till the autumn. So this feels like a holding statement, an attempt to reassure financial markets that Labour are serious about fiscal sustainability. But I think there are going to be some difficult decisions in the autumn when we're going to have a full-blown budget.
All right, well, let's see if that is the reassurance that the markets are looking for. Dan Hansen, Bloomberg Economics' chief UK economist, joining the program. Let's go back to Westminster and get more on today's spring statement. Bloomberg's Lizzie Burden standing by with a special guest. Lizzie.
Thank you, Critty. Well, really good to have Dan's framing there as we await that updated Office for Budget Responsibility forecast, as we await the latest policies from Chancellor Rachel Reeves. But we can discuss the framing and some of what we might expect now with Dame Meg Hillier, Chair of the Treasury Select Committee and Labour Member of Parliament. Really good to have you with me, Meg.
Pleasure to be here.
We're expecting the Chancellor to frame this spring statement today as pretty much all Donald Trump's fault. That's why we've got sluggish growth. That's perhaps why the OBR is going to downgrade its growth forecast. Do you think that maybe she should take a little personal responsibility here, though, for her tax rises and the gloomy narrative since she came to power?
Well, look, I mean, everyone wants to come into politics to talk about the sunny uplands, but she inherited a very big challenge. And so I think she was being very honest and realistic when she were elected last July and then in her budget. But look, and it is not unreasonable to say that the impact of Donald Trump's election and his erratic approach, the tariffs, his everything he's doing, even in around Ukraine, talk about what he wants to do with Canada. This is all very unsettling for businesses and across the world, and including in the UK. And it's not a comfortable environment to think about future investment with all of that uncertainty. So I think it's completely reasonable that she can point to that. She has also, of course, set out very clear fiscal rules. She was very clear as Chancellor and Shadow Chancellor before that she was going to be a Chancellor setting stability and certainty. And I think that her fiscal rules that she set, she is really clearly not going to move from. She told us that very clearly last November.
And she shouldn't be moving from them because we know she's got difficult choices. She shouldn't be loosening those fiscal rules to give us some more headroom.
Well, she was very clear to us and volunteered to us last November in front of the Treasury Select Committee that she would not be putting up taxes again. So she's very clear that's not going to happen. So really the only other option available to her is to reduce spending. This is something that I've spent a decade on a previous committee looking at public spending. Governments always want to trim this, so it's actually challenging to deliver. But there are opportunities there that can be taken, and some of them will be very hard choices, as we've seen in the last week.
Because she's told us that there'd be no austerity. Isn't that what we're going to get today?
No, austerity was a mindset saying we're going to reduce the size of the state and determine that we're going to do things differently. That was very much a conservative take under George Osborne. We're a government that wants to see investment in public services. And if you look back at that budget last year, it was actually talking about investment in schools and hospitals. We've seen further talk and investment in that. We're looking as a committee at the National Wealth Fund to see how that will instigate growth and investment. So there are seeds of hope there, but it's a very challenging financial situation that she's inherited.
But you'll know, Meg, that there are many in your party, including in the cabinet, who are saying she's choosing fiscal stability over social justice.
Well, government is about hard choices, and she came in and she is Chancellor. Her job is to make sure there is fiscal security. And of course, there are very big challenges in how you do that. We all come in, at every MP, whatever party, with our wish list of things we want to see, whether it be in our constituency or nationally. And we all have those demands. We want to see those changes. But until we have stability and economic growth, a lot of those will be hard to deliver. There isn't a magic money tree, and she's really clear about that. So she's set these fiscal rules. She's clear they're not going to change. But actually, they do, chancellors have changed them over the years, but never in the first year, so I do not expect any shift on that at all this afternoon.
On that national security point, just coming back to Donald Trump, the other thing that we're expecting is for the Chancellor to announce more defence spending, because that's what other countries are doing. But is that actually just a bit of fiscal accounting wizardry, because she's cutting the aid budget, putting it on defence, and by her rules that counts as investment?
Well, I mean, I think she wasn't looking at it doing it from that perspective, because let's be clear, there is a very big need to support Ukraine, and the Prime Minister's lent in very heavily and led on the world stage on that issue. But actually, but investing in defence, it boosts confidence in a lot of industry, because remember, it's not just defence industries, it's the supply chain to them, and defence jobs are around the country. So in terms of actually generating growth, there could be a real opportunity, which sounds an awful thing to say about something so tragic as what's going on in Ukraine, but there is a need to step up, and there is on the positive side for the UK, that could create jobs and opportunities for young apprentices as well.
But by that argument then, Meg, shouldn't she be doing way more? I mean, a couple of £1 billion more on defence is nothing compared to what Friedrich Merz in Germany's promising.
Well, then she's likewise got to look at her overall package and her fiscal rules. She's not going to just splurge. She's not she's not a chancellor who's just going to be giving out money that she hasn't got. And look, she's very clearly set on this trajectory. She's very clear about her fiscal rules. We will be challenging her, of course, on the committee next week. That's our job, and asking her about what we see today. I haven't yet seen the OBR's latest forecast, so that will determine what we ask. And of course, we're speaking to the OBR next week as well.
Yeah, just on the OBR, the Office for Budget Responsibility, the fiscal watchdog, it's arguably never had such an important role historically, right? Given the focus on growth, given the Chancellor's so, as you say, wedded to her fiscal rules, is it fit for purpose? Do you agree, a bit too optimistic about its forecasts?
No, I think it is a very good organisation that's fit for purpose. And let's be clear, who has lent into it and given it more responsibility? The current Chancellor, Rachel Reeves. She hasn't shied away from having scrutiny and challenge about her decisions, and has tied herself to the work of the OBR. But look, these are forecasts over a 5-year period. Obviously, the further out you get, the less certain things are. They would say that too, and you see that with other forecasters as well. So there were different methodologies employed, but they're very transparent about what they do and how they use it, and it's important that we have that check and balance on the system. And I'm sure it's not always welcome news for this Chancellor or future Chancellors, but the fact that she has said this is so important, I want to make it even stronger in law, I think is a sign of her confidence that she can be challenged. But we'll be challenging her next week. We won't give her an easy ride, because we're there to ask those tough questions that the electorate want to hear.
Well, we'll look forward to that at the Treasury Select Committee next week. Meg Hillier, really good to talk to you, Chair of the Treasury Select Committee and Labour Member of Parliament. Back to you, Kriti, Anna.
Lizzie, thank you very much. Bloomberg's Lizzie Burden in Westminster for us. You can join us for special coverage of the Chancellor's Spring Statement. That starts today at 12:15 p.m. UK time. We expect the Chancellor to stand up around 15 minutes after that. Subscribers will also be able to watch on the terminal, and we'll be live streaming our coverage on YouTube as well. So many ways to engage with our coverage there. And Kriti, it'll be, as we were hearing from Dan Hansen, could this be something of a holding statement? The markets will be poring over the detail either way. And it could be things she says that moves the market. It could be things the OBR says about their inflation expectations or growth expectations. We've seen that move market expectations in the past, certainly around the last budget. So that's one focus. We're also watching European stocks fade a little bit this morning.
Absolutely. The shares down on the stock 600, down about 0.6%. But the FTSE remains the outperformer, higher by about 0.1%. It's not a massive move to the upside, but certainly one that edges out some of its continental peers as well. It's worth noting as well that we are going to be having a conversation with the CFO of British defence company BAE Systems. They will speak to Bloomberg TV in just over half an hour, talking a little bit about that defence spending story and perhaps a little bit of what we may potentially hear from the spring statement as well. Plenty to discuss on the defense front. That conversation happening in the Pulse next. The markets are selling off. That does it for the opening trade. The Pulse is up next. This is Bloomberg.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
The US announces a ceasefire between Russia and Ukraine in the Black Sea, but Moscow says key sanctions need to be lifted first. US copper futures surged to a record on a Bloomberg report that President Trump could slap import duties on it much earlier than expected. And UK inflation unexpectedly cools and a boost for Chancellor Rachel Reeves ahead of her spring statement this afternoon. Let's check in on the European equity picture this morning then. Lacking direction, it seems, largely. Seeing a bit of upside when it comes to the FTSE 100 here in the UK, only very modestly, though, as you can see. Under pressure in France, the CAC around off by 0.7%. Over in Germany, down 0.7 as well. The Trump tariff uncertainty continues. We count down, of course, to what he is describing as Liberation Day on April the 2nd. The mixed messages around how far and how fast he wants to go. Here in the UK, inflation coming in slightly softer than expected. You're seeing a decent move in gilts. In fact, that is where more of the excitement is across these markets. So if we move on from the equity market to the cross-asset picture, where we can look at the UK 10-year, and across the curve here in the UK, you're seeing a bid for gilts and yields down. So as we've said, some relief then for the UK Chancellor ahead of that spring statement. 470 right now on the UK 10-year, basis point move of 5 on yields lower. The pound at 129, a little bit of softness then for the pound. Inflation coming in for the month of February at 2.8%, so below the estimates of 3%. Down 0.3% on the pound. Copper is in focus. This is the pricing on the COMEX. Of course, the exchange in the US, massive divergence in the pricing here. The prices up at copper on record levels versus the pricing on the LME here in London as well. On, again, the tariff threat from the Trump administration. US futures, after 3 straight days of gains, just pointing lower by 0.1%. So, for the conversations that matter and the insights you need, let's get the show started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Tom McKenzie in London, stepping in for Francine. Crossing the terminal right now. Some headlines around the bonus pool being put together by Wall Street. Wall Street's bonus pool surging to a record $47.5 billion for 2024. The average annual bonus rising by almost a third to 244,000 US dollars, 244,700 US dollars to be precise. And according to estimates by the New York State Controller, these are the details in terms of the lines coming through. Again, the headline, Wall Street bonus pool surging to a record 47.5 billion for 2024, and the average annual bonus up by almost a third. So good news for those on Wall Street. We'll see if, of course, that trend continues through 2025. The deal making will be crucial to that, of course, as well. Now, investors are searching for a clear direction amid weaker US consumer confidence and uncertainty about President Trump's upcoming tariffs. More on this. Let's bring in Bloomberg's Valerie Teitel. So, Valerie, if we put the bonus story to one side and focus again on the Trump tariff story, the volatility, the rhetoric, again, almost on a daily basis from this Trump administration, where do things stand right now in terms of how the markets are understanding what is going to happen on April the 2nd?
Well, look, Tom, the market is looking through a lot of uncertainty when it comes to this tariff back and forth. Are there going to be exemptions? Are there not? Or is it going to be targeted? Is it not? A lot of questions still out there. But the equity market in the U.S. with the S&P 500 has now notched 3 straight days of gains, up some 2%. Not a whopping number, Tom, but it should be noted. We've not notched 3 back-to-back days of gains in nearly 2 months. So nice to hit that hurdle. Seems like the equity market, though, is on a more solid footing as we head into that April 2nd deadline. One market, though, that is not on a solid footing, that has been rattled by recent comments from the Trump administration, is the copper market. I know you mentioned previously that COMEX copper hit some record highs in the Asia session overnight. We're seeing quite a divergence between COMEX copper, that's copper traded in New York, versus LME copper. This is something we don't see often, and it's because they're front-loading shipments of copper into the U.S., all these supplies going into U.S. ports, leaving some areas of the globe perilously short on copper supplies. So the copper market continuing to be rattled by threats from the Trump administration that these tariffs could come in a matter of weeks instead of a matter of months. Lastly, Tom, I want to end on the consumer confidence data yesterday. I thought this was important. Again, it came below expectations, below estimates. A shocking read on the expectations component of consumer confidence. This is the 6-month forward-looking component. Came at a 12-year low, but the equity market still not rattled by this. It seems to me that the market is looking for confirmation of the dismal consumer confidence to hit consumer spending. We might have hints of that in the PCE data on Friday.
Yeah, the forward look in terms of expectations from the US consumer out 6 months, pretty dramatic in terms of the drop-off. Bloomberg's Valerie Teitel, thank you very much indeed for the market check on tariffs and the consumer sentiment that continues, of course, to come under pressure stateside. Now to the geopolitics, where the US says Russia and Ukraine have agreed to a ceasefire in the Black Sea. The Kremlin, though, confirming the truce, but saying it is conditional on lifting sanctions. Joining me now with the details is Ros Matheson, Bloomberg's EMEA News Director. Ros, how much does this truce actually change things? To what extent has the needle now moved, potentially to a more lasting ceasefire?
Well, really, in a way, what this is about reinstalling the Black Sea grain deal that was in place for a while. But even when that deal was scuppered by Russia, Ukraine has continued to send ships through the Black Sea with grain. So tangibly, it doesn't change a whole lot on the ground, or rather on the water in the Black Sea for now. It's basically a version of that deal, perhaps a bit broader in scope. But as you say, Russia is putting a lot of conditions on here and really suggesting that for this to take proper effect, that it wants to see even more action on the sanctions front. I mean, the statement last night from the US talked about giving Russia relief in terms of bringing it back into being able to ship fertilizer more fulsomely, access to agriculture, possibly to payment systems, to easing the cost of insurance for Russian shipping. So there seem to be quite a few goodies in the bag there for Russia already out of this. And the question is this Russia just slowly walking towards some sort of broader ceasefire? And does that at some point become frustrating for Donald Trump? We saw him even raise that question last night. Does he think that Russia is going slow? He said possibly they are, although he believes that they do seriously want a full ceasefire in the end as well.
Yeah, President Trump suggesting that his Russian counterpart is maybe dragging his heels on this deal. But nonetheless, as you say, the Trump administration touting this at least as a modest win. On the flip side, when it comes to the security challenges stateside, the remarkable story and the continued fallout around the Signal group chat and the involvement of a journalist in that chat. What has the fallout been, Roz? Is it likely to put a permanent dent in this Trump administration?
Well, certainly you can see that all the parties involved are coming out strongly to say that they don't feel anything inappropriate happened here, and that saying that they don't think any classified operational information was shared in that Signal chat. That runs counter, of course, to what the Atlantic editor-in-chief, who was in the chat, says that he saw, which was highly classified operational material around this planned strike on the Houthis in Yemen. You can see, obviously, this is causing a bit of a political storm in Washington. They all had to come out yesterday to say, kind of, yes, this happened, but downplaying it as a big deal. National Security Advisor Mike Waltz is saying he regrets that it happened, but again, not saying that there's been any wrongdoing here. So Democrats will push hard on this. You can imagine it's difficult to see what traction they'll get out of it. There is a lawsuit already, but that's more about just barring these officials from using Signal in the future to discuss such high-level classified information or plans around things such as attacking the Houthis again. So it's about limiting the use of Signal versus punitive action against these officials. And Donald Trump for now is standing very much fully behind all of them, including Mike Waltz, including his defense secretary, Pete Hegseth, who was allegedly the one who shared the confidential data in that chat. So it's causing a political firestorm. Obviously, it's again, an eye-opener for allies, including in Europe, but it's unlikely to necessarily mean much in the end in terms of the Trump administration.
OK, Bloomberg's Roz Matheson with that important framing. Thank you for the latest. To the UK now, where inflation unexpectedly cooled, strengthening the case for the Bank of England to cut interest rates again in May. We've seen the markets pulling forward those bets in the last hour or so on the back of that data. The data also providing a morale boost for Chancellor Rachel Reeves. And my goodness, did she need one ahead of her spring statement today. Bloomberg's Lizzie Burden is at Westminster for us. What does the inflation data mean then for the Chancellor? Does it change anything around the spring statement, Lizzie?
I don't think it does, Tom. It may give her a bit of a spring in her step, and as you say, she really needs one, because the fact is we've got sluggish growth in the UK economy. We've had a rise in long-term gilt yields and therefore government borrowing costs since the start of the year, and it looks like that's going to mean that Rachel Reeves' headroom that she left herself back in October, £9.9 billion, has been wiped out. And in fact, our economists at Bloomberg Economics expect she's going to need to find £17 billion today. Now, she's already said that there'll be £5 billion of welfare cuts. We know that. We know that there's going to be cuts to aid to fund defence. Actually, that's a bit of accounting wizardry because it counts as investment, so that gives her £2.4 billion. But it still leaves her having to find £10 billion, and we're expecting that to come from day-to-day departmental spending budgets. We'll know the total, but we'll find out in June in the spending review where exactly the pinch will come. Now, none of this is easy for a Labour Chancellor to deliver politically. Welfare cuts, aid cuts, cuts to the pensioner winter fuel allowance. It's causing disquiet among not just her party, but her cabinet too. But the even bigger problem, perhaps, is that where Rachel Reeves is blaming the global uncertainty for this mess, there likely could be even more of it to come. Remember, her payroll tax rise announced in October comes into effect just days after Donald Trump's Liberation Day, when there are all of these tariffs around the world and the retaliation that we expect to follow. And so it could be that whatever headroom she leaves herself today is wiped out by the autumn, and there's even more pain to come, potentially from tax cuts later in the year.
OK, Bloomberg's Lizzie Burden, thank you. I was about to say tax cuts might be broadly welcomed by many of our viewers if that was the prospect, but it seems pretty unlikely, doesn't it? But tax increases is the threat, isn't it? Possibly in the pipeline for this Chancellor further down the road. Lizzie Burden on the ground for us, Abingdon Green, outside, of course, the Houses of Parliament ahead of the spring statement, and we'll bring you all the details and continue our coverage of that important speech later today. Let's get the analysis right now, bringing Catherine Nice, Chief European economist at PGIM Fixed Income. Catherine, thank you for waiting patiently in the wings for us here in the studio. Let's start with inflation data then. Is this the start? Do you see a picture of inflation in the UK that is looking more benign, or is this as good as it gets? Do things start to change negatively on the inflation front towards the back end of the year, or are we looking now at a trajectory more closely heading towards that 2% target?
I think it's probably too soon to say. I think we can be pretty confident that inflation is going to go up from here over the course of this year. But of course, today's print is very good news. It's great news for the Chancellor this week, as your presenter just pointed out. And of course, it comes sort of hot on the heels of better news also on the flash PMIs, which are probably, one of the best indicators we have of what is happening, right now in terms of the real economy. So there again, we had a bit more of a positive, outturn, especially in domestic services sector. So that puts things in a better starting point, I think, just for today in terms of the messaging. But as Lizzie pointed out, it's not going to solve the problems of the world, and I think that those screws will be turning tighter as we progress through the years, including on inflation.
Where does that leave your projection around growth for the UK then?
So I think the big wild card here is what is going to happen with tariffs. And so that makes making a projection for tariffs very, very difficult. And the key point to stress here is it's not so much tariffs that are being levied on the UK, but really on the euro area, because the euro area is still our largest and most important trading partner. And that is a big unknown about how severe these trade tensions between the US and Europe are going to be. And I think there's a real risk that we could kind of go to hell and back in some ways on tariffs, where the threats could ratchet up. We may end up in a place that doesn't look too bad, but all of that uncertainty and the prospect that we could land in a very negative place, I think, is going to be quite dampening. And again, you see that in the PMI data. The manufacturing for the UK continues to be very weak.
Are the markets right then, given the softer inflation print of today and those challenges coming through from the Trump tariff regime, to pull forward? Are the markets right to pull forward their bets on rate cuts for the BOE?
So, the Bank of England is, the UK policy mix is stuck in a chicken and egg situation. We need rates to come down in order to take the fiscal pressure off, but you can't take the fiscal pressure off without having a credible plan, because that could drive rates higher. So there is a sequencing problem here. And I think what we need to see first is the Labour government in the autumn statement, what we're expecting today, it's going in the right direction, but it feels a little bit incremental. We need to see more. I think markets aren't quite convinced in terms of fiscal responsibility, and that signal is needed in order for the Bank of England to come down. I think we can be confident that interest rates are coming down in the UK, but this is a very narrow path that the Bank of England and the fiscal authority needs to tread in order to get that sequencing right. And there's a risk, if they don't, that we won't see those cuts come down.
Okay, so the markets and traders within gilts as well, they're still kind of watching with eagle eyes in terms of what comes through on this. I mean, we're seeing yields down across the curve today, but you're suggesting that could be short-lived, because market sentiment could change again.
Absolutely. I don't think that this vulnerability, I don't think that treading this narrow path is going to be clarified by what we hear from the Chancellor today, because I think that, a lot of what is going to be announced, the market's already baked in. It's essentially just restoring the wafer-thin headroom that she already had. It's not really going to go far enough in terms of really demonstrating, I think, clearly that these tough decisions are being made in terms of cutting back on spending in a way and being fiscally prudent in a way that the market really takes as a strong signal, and then gives space for the Bank of England to start cutting. It's just a very difficult, narrow path. And it hinges also a lot on what is happening on rates elsewhere. If rates are higher in Europe, in the US, what's the benefit to buying UK gilts? So, there's that relative value point as well.
Just very briefly before we let you go, on that international picture, how much is priced into bunds at this point on the defence spend out of Germany?
I think too much. I think, it is a game changer what we're seeing in Germany, but it's going to take time for this stuff to hit the ground. This stuff is not shovel ready, either on defense or infrastructure. It needs to be complemented to be really impactful by reforms, We don't know yet what that's going to look like. We don't even have a German government yet. And maybe they burned a lot of political capital to jam this money through.
Yeah.
So I think it's maybe going to underwhelm a little bit relative to that initial impact.
All right, very interesting. Catherine Nice, thank you very much on the UK, and of course a line as well on the German defence spend, and maybe some questions that need to be answered before we get more confidence in how that story evolves. Catherine Nice, Chief European Economist at PGIM Fixed Income. Coming up, more on the spring statement. I'm going to be joined by John Caldwell, British entrepreneur, of course, and founder of Phones for You. His views coming up. This is Bloomberg. Latest in tech and AI news whenever and wherever it happens. I'm Tom McKenzie in Paris, and this is Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal?
Are markets too optimistic?
How do you worry about the things that are outside your control?
How does the current fighting completely stop?
I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Welcome back. We are just a few hours, of course, from the UK spring statement, a crucial test for the Labour government. My next guest was a long-term Tory donor and last summer switched alliances and voted for Labour. Ahead of the spring statement then, John Caldwell, British entrepreneur and founder of Phones for You, joins me. John, thank you for taking the time. Of course, a prominent voice within the British entrepreneurial scene. John, how are you feeling right now about this UK economy?
Overall, I would say very disappointed, because I think Labour are doing a lot of things that are arguably very wrong. They are doing a lot of things that are right as well. So, you know, there's some good stuff coming down the pipeline that will make a difference. But for me, everything feels like too little, too late. There isn't that dynamicism that I would expect out of leaders. I mean, we never get that with politicians. We know that. We very rarely get real action, and action that is the correct action done in a proper way. But, you know, it really feels as though Labour are slow off the mark, and this is crucial for the UK economy.
Slow off the mark. What kind of score would you get? How would you grade this Labour government then at this point, John? I mean, you talked about the need for GDP growth, for a focus on the environment. The outlook for growth is expected to be cut later today. Inflation has made a bit of progress, but we face potential tariff threats. There is still concern about how much fiscal firepower this government has. How would you grade this Labour government at this point?
Well, that's an interesting question, Tom, because first of all, I have to say there's 2 answers to that. One's an absolute answer and one's a relative answer. Relative to how I consider that the other parties would have performed, I think they're doing okay. In absolute terms, I would expect them to do a lot more and a lot quicker and be smarter. I think some of their measures and actions that they've taken, especially in the budget, were wrong. There's so much more that they can do to attract inward investment. I think they're relying on certain actions that they've taken to improve the economy over the next 3 or 4 years. But the actions that they've taken, I don't personally think will have a significantly positive effect to really match up with anywhere near my expectations.
So, John, what is the policy prescription then? What would you put at the top of your list that this government should reach for, should target to reinvigorate the growth of the UK economy?
Gosh, that's a whole day's discussion, but let's just pin it down to 2 or 3 things. Firstly, really cutting the state sector cost. We've got 1.2 trillion of state spending. If I couldn't cut 3 or 4% off that, which would be 30 to 40 billion pounds a year, if I couldn't do that quickly and effectively without damaging the country's economy, then I would sack myself without any shadow of a doubt. That's the first thing. The second thing alongside that, which is a bit slower, but attract inward investment. Now, Labour say they're doing that by deregulating planning and by deregulating in general, and absolutely that is an important factor in any country's economy and attracting inward investment. But they need to do so much more, and it's no good relying on deregulation to do the job. We need an attractive package to go to businesses all around the world, and I have literally been preaching for now 5 years, first of all to the Tories, that we need to attract the very highest technological companies into Britain, and especially those to do with the environment, because without doubt, environmental technologies, intellectual and product, will be a massive export item in the future. And if we became the Silicon Valley of the environment and technology, Britain's future would be absolutely assured.
John, it's interesting. It sounds like in terms of cutting costs, you think we should have kind of a DOGE, a Department of Government Efficiency here in the UK. But I know you're also kind of touting the idea that we could benefit from a kind of brain drain as well out of the US. Do we need our own DOGE?
Well, yeah, but not DOGE as it's being done by Elon Musk. Absolutely not. No, it needs to be done selectively, intelligently, and slower than that. You can't do it like it's happening in the States without really damaging the infrastructure. You have to make intelligent decisions on every single person, and that would take probably realistically a couple of months if you're assessing, say, 600,000 civil servants. And by the end of a couple of months, you'd have people in red, amber, green. The reds you would know you need to get rid of, the ambers you need to make better or make more efficient, and the greens are all go. And that would take at least a couple of years. You can't just go in and sack people willy-nilly. That's wrong. That's absolutely wrong.
John, was scrapping the non-Don status the right move?
No, totally wrong. Totally wrong. You know, it was wrong on 2 issues. It was wrong financially for the country, and it was wrong from a fairness point of view. And let me put the fairness point of view first of all. If people came to the UK 2 or 3 years ago for non-Dom status, and most of the worldwide earnings that have been achieved whilst in other places, whether it was Dubai, Monaco, or wherever it was, if their earnings had been achieved somewhere else, why should they have to pay tax on their entire earnings suddenly 2 years later, having lived in the UK? That's not fair. It's not fair. It's not right. But equally, it's driving them back into places like Milan and Monaco and Dubai. And we cannot afford those moneymakers.
Are you seeing some of those moneymakers snapping up your flats in Mayfair, John? How's that going? It's been a tough environment for the high end when it comes to the London property market. Are you seeing decent sales? Okay, and what's the pricing like?
We're definitely seeing a big interest in American interest. There's a lot of Americans coming over now and looking for apartments and talking about citizenship in the UK. So that's positive. On the negative side, we're definitely losing very wealthy people into Monaco, Milan and Dubai, and that's really disturbing.
Okay, John, really appreciate your time, as ever. John Caldwell, British entrepreneur, of course, founder of the former mobile phones retailer Phones for You. We appreciate your time. Coming up, an exclusive conversation with the CFO of BAE Systems, as defence stocks, of course, benefit from Europe's military spending boost. That conversation is next. This is Bloomberg.
In case you missed it on the China show.
Compared to a 10% tariff on Chinese export to the United States, I mean, even the entire determination of the fentanyl industry in China is totally worth it.
I think this is a monumental moment for global AI development. DeepSeek did was not only just make the products free, but also they released the entire research open source so you can see how they did it. This has forever democratized this current most advanced version of AI.
How do your students feel about their jobs prospects?
There are a lot of opportunities in this AI application fields. On the other hand, if you look at traditional manufacturing, I think the main problem is that there's a lot of mismatches between supply and demand.
Don't miss the China show live every weekday.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Good morning. Welcome to The Pulse. I'm Tom McKenzie in London. These are your top stories. The US announces a ceasefire between Russia and Ukraine in the Black Sea. Moscow, though, says key sanctions need to be lifted first. US copper futures surged to a record on a Bloomberg report that President Trump could slap import duties on the metal much earlier than expected. And UK inflation unexpectedly cools in a boost for Chancellor Rachel Reeves ahead of her spring statement this afternoon. Now to the defence space. Mario Draghi saying that Germany's decision to ramp up defence spending is, quote, a game changer. But the former ECB president warns there are risks when it comes to how it's implemented. Let's bring in Bloomberg's Oliver Crook for the latest then. Ollie, you focused very squarely on the Draghi report when that came through. That was a key part of your reporting. How does what we hear from Draghi today change the view on the defence spend of Europe?
What I think is really interesting, Tom, is when you think about when the Draghi report was originally published, which was back in September of last year, right? This was a completely different world for Europe in September of last year than what it is today. This is even before Donald Trump was elected president of the United States. And there are many ways in which, Tom, Donald Trump is actually Mario Draghi's sort of greatest ally in sort of putting the pressure and the urgency on the Europeans for what basically Draghi was basically forecasting for the European economy. He was basically saying that the European economy was doomed to obsolescence. That was in large part basically due to some of the actions from the United States, even under the Biden administration, Inflation Reduction Act, and basically how uncompetitive the European economy was versus the United States, but also China, right? And now we live in a completely different world where the defense paradigm has been blown to pieces. We talk about basically now industrial policy in the United States potentially being even more threatening to Europe than the Chinese policy is. And this is basically what has got policymakers in Europe to actually wake up. And part of the evidence of that is what we're seeing in Germany. I think what his concern is, though, is that basically you get into a position where Germany is going to do a lot of this spending on defense, going to do a lot of this spending on infrastructure, which is really in keeping with what Mario Draghi has been saying even before he was in this position when he was at the ECB, saying that fiscal policy needs to start picking up its weight. But the problem is that it may not get to that European level, right? What Mario Draghi has been talking about is getting basically not national champions, getting European champions, doing M&A to get these companies in sort of a way to compete internationally, but also talking about obviously joint debt as a potential lever to pull in order to get new money into this defense industry. So listen, I think that in many ways the Donald Trump administration really has helped Mario Draghi getting his message across, but is it enough to basically go all the way of what Europe needs? That we'll still have to see.
And meanwhile, Ollie, the US saying that a truce, at least partial truce in the Black Sea has been agreed between Russia and Ukraine. What are the details of this agreement? To what extent does it actually move the needle?
Yeah, Tom, this is really interesting. When you actually start digging into what we got from each of the different parties, it sort of clouds the picture a little bit. Yes, you did at the sort of top line have an agreement to basically begin to have commercial shipping be sort of re-permitted across the Black Sea and basically have a ceasefire from any sort of targeting of those kinds of operations. The issue is you had basically 4 statements out from these 3 different parties, 2 from the White House, 1 from the Ukrainians, and 1 from the Kremlin. Basically, they all said that there had been some sort of deal sort of agreed to. However, when you look at the Kremlin statement, and this is very interesting, I'll quote sort of directly from there, that basically this ceasefire and this proposal is contingent on the following. It is contingent on the removal of sanctions imposed on financial institutions involved in ensuring international food trade, their reconnection, those financial institutions, to the SWIFT payment system, which we should say, Tom, is really at the heart of that sanctions regime that is against Russia right now. Also removal of sanctions on companies producing and exporting food, and also allowing basically the servicing of ships in ports and lifting the sanctions against ships flying the Russian flag that are involved in the food trade. Now, the U.S. administration statement didn't go that far. They said that, yes, they would help the Russians begin to get sort of re-access these markets, but they didn't go that far into going specifically into those details, which echoes sort of what we heard the last time around when basically the United States said that the Russians would agree to not strike energy and infrastructure. It was actually just energy infrastructure. So again, when we think about in the context of what Trump wants to achieve, how soon he wants to achieve it, there is still a major question of how much daylight there is between these 2 men, between Putin and Trump. And Trump even alluded to himself, alluded to it yesterday in an interview, a Newsmax, saying that basically he sometimes has done this himself when he's trying to not sign a contract and kind of stall for time, and saying that maybe that's actually what Putin is up to now.
Bloomberg's Oliver Crook with the latest on that Black Sea deal and the questions that still remain. Ollie, thank you. Remaining on the defence space and with the lens on the UK, because the Chancellor here, Rachel Reeves, set to announce an extra £2.2 billion in defence spending over the next year in her spring statement later today. That's as the government aims, of course, to increase defence spending here to 2.5% of GDP in the near term. It comes amid a wider military spending and security push that Ollie's been talking about in Europe. We're joined exclusively now by Brad Grieve, CFO of the London-based defence contractor BAE Systems, a crucial player, of course, within the global defence space. Brad, thank you for your time. £2.2 billion, how significant is that? How much of that flows to BAE, and how are you putting that to use?
Yeah, thank you, Tom. Well, we are the largest defence contractor in the UK, so, we are ready to support the government and its spending plans. And, of course, the Strategic Defence Review is something that we all look forward to seeing, and I think that will lay out a lot of those priorities that I think we are very well placed to support the government on.
On Europe, 150 billion euros in terms of the rearmament fund, but US and UK companies largely kept out of that until we sign a security pact with Brussels. Are you pressuring the government to do that? Do you expect that to happen? Do you expect the government to sign that pact so you can access that funding?
We already have pretty significant access to European markets anyway, so, today we have a £78 billion backlog that we announced at the end of last year when we talked about our results in February. And of that £78 billion backlog, almost a quarter of that is non-UK Europe. So we already have a very significant and material exposure to the Europe market. And that comes in things like MBDA, where we're 37.5% owner on. It comes through things like the Hägglunds and Bofors businesses that are made in Sweden. These are combat vehicles sold into Europe. And, of course, the F-35s that a lot of European nations are buying, and we have a work share on that program. So there's a lot of ways that we already participate in that European market. And I think the spending plans that are being announced, I think we will also see benefit from that.
How would you characterize this moment, Brad, in the defence space?
I think your earlier speaker had a good expression. I think it's a paradigm shift. I think things have fundamentally changed. You look at since the end of the Cold War till today, there's about a 1.8 trillion underspend across Europe if you define 2% of GDP as the right level. So there's a catch-up that needs to be played, and there's also a rearming and a replenishment of the inventory that's gone into Ukraine. So we think that there's a very long-term super cycle that's going across European defense right now, and I think we're only just at the beginning of that.
And you talk about that 2% target. NATO setting its future target in June, 2%. Is it likely? Should it be higher than that 2%? What are you expecting from that NATO decision?
Yeah, we'll have to see. That's a pretty important milestone. We do expect to see a pretty significant increase above that 2%. I don't know what that's going to be, but if it's, let's say, 3%, we're talking about 100 to 200 billion more in annual spending across Europe to get there. So it is, again, support for this super cycle that we see.
Should you as CFO put the primacy right now on investment versus returning cash to shareholders, given the defence needs?
Well, we are doing both. I mean, we spent close to £1 billion in capex last year, which is a record for us, and that number will be similar again in 2025.
So about $1 billion in 2025.
Exactly.
Which areas? Where will that capex be focused?
Yeah, we're spending on to drive the growth that we have in the backlog, and beyond that £78 billion backlog, there's about $180 billion where we're the incumbent on positions that will eventually turn into backlog. So the pipeline is more than 9 times our current revenue today. And so we are building CapEx to drive that growth, but we're also increasing investments to drive the efficiency of how we deliver. And what we're trying to do is optimize defense capability per pound or dollar spent by our government customers. And so investing in CapEx to improve efficiency is part of that.
Given that backlog then, and the huge demand that's coming through, does that $1 billion in terms of CapEx spend seem a little under ambitious? I mean, you need to be doing a lot more. Can you deliver on the demand that's coming through? Is the spending, the investment that you're pledging going to be enough to deliver on the orders that you expect?
Yeah, we're spending record levels already, and we need to see the government spending plans, and they are plans right now, convert to actually orders. And once those orders come in, we're ready to build capacity to deliver those. But if you look at our combat vehicles business, we delivered over 600 vehicles in 2024, and that's going to be significantly increasing in 2025 with our existing investments that we've made. So we're already building for growth, and we're already delivering more capacity. With our munitions business in the UK, we've increased investments to deliver an 8 times increase in capacity in the UK. Yeah. So we're already making those investments.
But it sounds like once you get clarity from the government plans, you could step up that
Indeed,
CapEx.
That's exactly right.
And you'd be ready to do that this year if you get that clarity.
We are absolutely ready to support our governments.
You've been on a road trip, and you've been speaking to investors all over the world. How has the sentiment amongst investors changed?
Yeah, there's, I think, a recognition of that paradigm shift. There's sort of 2 macro tailwinds that are affecting the industry right now. One is obviously the clear need for Europe to become more independent on its defense and to bolster its capabilities. We can see that every day, everywhere, in what we read and what we see and what we hear from our governments. And so that European drive is very clear. And then the other one is the U.S.'s focus on Indo-Pacific. And that brings its own set of capabilities that are far different to a European theater. And then if you look at our U.S. portfolio, our strategy has been to get closer alignment with the national defense strategy of the U.S. And that's why the acquisition of Ball Aerospace is an important part of that, where space becomes a very important part of the Indo-Pacific theater, as does electronic warfare. And so those are the 2 areas that we've been really investing a lot in the last several years, and that plays well into Indo-Pacific.
Are you going to step up investments as you look at those new technologies, whether it's drones or satellites or artificial intelligence? Are you ready to pull the trigger on more investments in that space this year?
Yeah, absolutely, and that's exactly what we've been doing. And if you go back to the U.S., one of the key areas of focus for the U.S. strategy is about protecting the homeland. And you've read things about the Golden Dome, which is sort of the Iron Dome equivalent in the U.S., and that takes a lot of what we have in terms of capability, especially in space. So those investments, that we've made recently, I think will play well into how this administration is looking at its defense requirements.
How much are you setting aside for acquisitions this year?
We have plenty of capacity. We have a very complete portfolio today. So every warfighting domain, we have very good coverage in. So there's no glaring missing parts of the portfolio. So we'll continue to look at bolt-on acquisitions, things that are technology infills. And we've made quite a few of those in 2024. So we acquired a lot of drone capability. We also acquired counter-drone capability. And as we've seen in Ukraine, this goes from strength to strength in terms of its importance.
There's some suggestions that the Italian manufacturer, Iveco, that you could be looking at their defense unit. Can you confirm that would be of interest, that is of interest? Have you had any talks with Iveco?
Yeah, I wouldn't comment on anything like that. I mean, clearly we have a very strong combat vehicles business. And, if you look at what we do in the U.S., we have a fantastic portfolio there. And in Europe, I mentioned Hägglunds and Bofors. So, what we have today is pretty complete.
You have a joint venture with Leonardo and with the Japanese manufacturer as well, JX, around a future fighter jet. Can you give us an update on the program and how far that's kind of evolving, how much progress you've made on that front, and what costs are looking like?
Yeah, Tom. So the GCAP program is one of these once-in-a-generation programs. So it's a 6th-gen fighter capability that, as you say, is in combination with industrial partners in Japan and Italy. And we're making really good progress. I mean, ultimately in the UK, we think that can support up to 16,000 jobs. So the joint venture has been announced, pending regulatory clearances. we hope to have announcements on that final legal structure, sometime in the coming months. So we're excited by the progress, and we should have a flying demonstrator up in there in the next 3 years.
Are you comfortable with costs? What are the projected costs at this point?
Well, I mean, we are supported by the funding that we have in place, and that program is going to be a long-term program.
And did the Saudis become a partner in that program?
That's for the government to decide. Those are the governments of the consortium need to figure out what partners they want in. But there's certainly room to add capabilities and partners, but that's really for the governments to decide.
Back to the investment shift that you're seeing and your conversations with investors. Obviously, for a long time, the defence space has been shunned by parts of this investment community, pension funds, ESG funds. That is starting to change now. Does BAE deserve to be in an ESG fund?
Well, we think that security is fundamental to a free society, and I think our government's primary role is to protect its citizens, and so we firmly believe that defense contractors play an important role in protecting the system of the West that we hold dear. And so, yeah, I absolutely think that BAE Systems fits well into that context.
On the credit rating, you're BBB. I'm going to get into the weeds a little bit. You're the CFO. You've got a BBB rating for most of the agencies. Given the backlog, given the demand, given the impulse around the spend around defence, do you deserve to have a credit upgrade? Does it give you enough room to manoeuvre?
We've got a very strong balance sheet. The ratings for the Moody's, SPs, and Fitches to decide, so I'll let them do their work. But we have a very strong balance sheet, and a balance sheet that gives us the capacity to do what we need to do, which is grow our business. And we've been allocating capital in ways that really have been value creating for our shareholders and helpful for our customers as we talked about, as we increase investments for them.
You talked about space earlier in the conversation. Is Europe vulnerable given its reliance on Starlink, and can that capacity be filled by European or UK manufacturers?
It can be, and there is a gap today, and I think that dependency is pretty strong today. So I think that is one area that Europe and the UK will need to focus on as it tries to create more independence. That is a key capability that is underinvested in because of that reliance on the US.
And the time frame for filling a gap around Starlink and around that capability?
Yeah, I won't put a timeline on it, but this is years, not months.
Okay. And you are confident overall in terms of the pipeline you can deliver. I think that's a key question, isn't it, for governments and for your clients, before we let you go, that you can deliver on this huge pipeline and the orders. You're confident you have the CapEx spending and the build out to be able to deliver on these orders in the time frame that's needed.
Yeah, absolutely. We've grown our headcount by 15,000 people in the last 2 years. So we've been ramping up considerably, and we've been increasing CapEx, as we said, and there's more room to go on that, and there's more growth to go. With our guidance that we've given in 2025, we're looking at a 10% compound annual growth rate over these last 3 years on the top line, and we think with the backlog and pipeline, we're set for continued growth.
Okay, Brad, thank you very much indeed for taking the time. Brad Grieve, of course, BAE Systems CFO, and that exclusive conversation focused, of course, on the all-important defence space. Coming up to the metal space and what's happening on the tariff front, copper trading in New York hits a record. Bloomberg understands US tariffs on the metal could be coming within weeks. We're going to bring you the details. This is Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
The soft data would tell you that the U.S. consumer is being a bit more cautious. They don't have quite as much confidence. The hard data is not in yet. The hard data will be in a few months. But I would say it's interesting to see how, raising rates almost 400 basis points the last couple of years didn't create a slowdown of financial conditions. But this administration, quickly because of headlines, has created a bit of concerns.
The president of Apollo Global Management, Jim Zelter, on the uncertainty coming from the White House. And staying with the Trump administration, let's turn to our scoop this morning. Bloomberg understands U.S. tariffs on copper imports could come within several weeks. That would be months earlier than the deadline for a decision. Copper trading in New York rising to a record. Let's bring in Bloomberg's senior executive editor for energy and commodities, Will Kennedy. Will, congratulations to you and the team on the scoop. How big a deal is this then for the copper markets? There had been a timeline put in place by the Trump administration. It seems like that's being pulled forward.
That's our understanding based on our reporting last night. When they'd done similar investigations in the first Trump term, it had taken 10 months to reach these decisions. But what Joe and the rest of the team discovered last night is that there's a lot of appetite within the Trump administration to impose these tariffs in copper within weeks. Now, what's been happening is that traders have been moving many, many tons of copper from the London market to the New York market, as you reported there. That spread has really blown up to more than $1,700 a ton, so sort of more than 10% of the price. It's a real market dislocation, and a lot of metal is on the water traveling into the US. The risk now for many traders is, A, these tariffs don't come in at the level at the time predicted, and B, if they do, will they get their metal into the US in time? So it's really adding to the sense of market dislocation and the volatility that the whole tariffs and the slightly chaotic way in which they're introduced is adding to volatility in metals markets.
Yeah, that dislocation is unprecedented, isn't it? So we have this race on the high seas to get copper into the US markets. Talking the high seas, the deal between Russia and Ukraine, as the US describes it, in the Black Sea. Talk to us about the impact that that's having on the soft commodity space and oil.
Well, the Black Sea has obviously been a zone of conflict, and it has had an impact on shipping markets. Earlier in the war, there was this deal to get grain out of Ukraine. In truth, goods have been flowing across the Black Sea. We are seeing grain exports from Ukraine. We are seeing grain exports from Russia, the world's biggest wheat exporter. So the impact won't be huge, and it's important to say that it doesn't seem this has actually been agreed, that Russia seems to be demanding quite a lot before this actually happens. But as tensions lessen, what it will do is reduce shipping costs down the line potentially. Clearly, stuff is flowing outside the Black Sea, but it's expensive to hire ships who are willing to go to the Black Sea. It's expensive to insure them. If we do get a de-escalation, those costs will reduce and ultimately feed through into the prices that are paid on global markets.
Will, thank you very much indeed on the Black Sea, the impacts on soft commodities, oil, and of course the Bloomberg scoop around copper and that dislocation on prices with potential tariffs coming through quicker than some had expected. Our executive editor, of course, Will Kennedy. Now, to the bonus story and another I mean, certainly for our audience, a key story when it comes to what is happening on the financial front. Average Wall Street bonuses surging last year, with the total pool for payouts jumping to a record $47.5 billion as industry profits soared. The average annual bonus rising by almost a third to $244,700, just to be precise, in the first significant increase since the COVID pandemic. That is according to estimates by the New York State Controller. Let's bring in Bloomberg's Jenny Serrain. Jenny, champagne corks popping then on Wall Street. What's behind this?
Yes, I mean, I think certainly about a month ago they were. So it's important to remember that this is all backwards-looking data. So this is for the 2024 year, and it's really important actually to remember kind of where we ended the year, because that's when a lot of these decisions were being made by the big banks. So at the end of the year, you had Trump coming in. There was a lot of excitement about what he might mean for capital markets activity, for deal-making activity. Everyone kind of thought that those were all up arrow. We had already started to see sort of a flurry of activity around the different markets. And so that was sort of the mindset that they were in at the end of last year when they were setting these bonus pools and handing out these bonuses in recent months to these traders and bankers. What I think, will be interesting from here is how, now that Trump has actually come in and we haven't quite seen a lot of that activity materialize, whether or not that excitement and exuberance remains.
Well, that was going to be my follow-up question, Jenny. I mean, what is your expectation? What are banking executives kind of hinting at? It's early days. We're only in March. But does this trend, I mean, if the deal-making picks up, if rates remain kind of on a downward trajectory, can we expect that maybe the activity around bonuses, that we could kind of maintain at these levels or maybe even edge a little higher? These are record levels, after all.
Yes. No, I mean, Wall Street famously is an eat-what-you-kill business. So if things turn around and if things pick up the way that we came into the year thinking that they would, then certainly I think there's always room for these payouts to grow, and banks have shown no sign that they would be ever unwilling to not pay folks for good performance. But if things keep trending the way that they have been, where the economic uncertainty, the potential tariff or trade war, and all of this kind of general geopolitical uncertainty that still is prevailing, if that keeps weighing on corporate sentiment, if we don't see deals get done, if we even start to see it cause a damper on trading volatility, then I think it will be a very different picture this time next year, which for the comptroller, of course, who's really focused on that tax revenue that comes out of these bonuses, it would be obviously a bad sign for the New York budget in a way.
Jenny, what is the biggest catalyst for these banks right now? Is it the rate trajectory of the Federal Reserve, or is it expectations of a slightly slower paced U.S. economy in terms of the growth picture?
I mean, I think on the deal-making and trading side, which is where you're kind of looking at these bonuses, it's a lot of it is just sentiment. And so it's obviously the rates picture and how the Fed comes in here and how they react. But I think it's also just the idea that do corporates know that the environment that they are going to be doing a deal in will be the same environment that, they're living in a year from now. And for as long as that uncertainty persists, that will be a natural damper on any type of deal-making or capital markets activity. You just see a lot of folks saying, I don't know what's going on. I don't know what the environment's going to be. I'm going to sit this one out and be on the sidelines. And so bankers hate that. Obviously they want a raring and ready to go capital markets. So I think that sentiment piece is really crucial in their minds to kind of turn this around.
Yeah, the gravitational pull of that uncertainty that, of course, continues. Bloomberg's Jenny Serrain, thank you very much indeed on the bonus story, a record coming through for Wall Street. Don't forget our special coverage, of course, of the Chancellor's spring statement. That's at 12:30 p.m. London time. Let's check in on the UK markets right now. A bit of good news for the Chancellor leading up to this spring statement, with inflation on the headline coming through softer than expected. You've seen a bid for gilts, the pound a little softer, the FTSE 100 currently flat, also looking for direction. It's up about 6% year to date. The pound is at 129, down 0.3%, a little softer then, and the bids for UK government debt yields down 5 basis points on the front end 2-year at 4.24. Up next, Bloomberg Surveillance.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
What legacy I would love to leave is to make sure that in my village I have infrastructure. So long when I'm gone, things are still working, then I have done my job. And if some people get inspired through my work and then try to engage themselves for their community and create something that is inspiring for everyone, I will be happy.
What's the best piece of advice you would give to someone young who wants to make a difference actually in this world? In architecture or with something else?
Wow. I'm not the right one to just do that.
I think you are.
Yeah, but with the pressure you have, and then you try to be the good one, the fancy guy, the intellectual one, I have no advice than to believe in yourself and really work hard. You know, when I started, no one would have imagined that I will be able to see my name connected with Aga Khan or Pritzker or sitting at Bloomberg to talk about sustainability, about future of safety. No. Myself 5 years ago, if you told me that, I will say no. I will never imagine. So I will encourage everyone to believe in what you're doing and not try to run after the newest of the newest. Just be consistent. Just work on things that matters for you. Really, at the long term, it pays.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
The kind of uncertainty that's being created by the chaotic tariff policy is something that has to give anyone pause.
It's been more of the uncertainty around policy that has crimped our forecast.
We will get some clarity next Wednesday. I think the big question is, does the market like that clarity?
The correction in the market is the market telling we don't like these policies or we don't understand these policies.
I think there's a scope for it to be peak policy uncertainty.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Wednesday on a 3-day winning streak as a softer tone emerges from the White House.
It's reciprocal. We're just going to be reciprocal. In fact, I'll probably be more lenient than reciprocal, because if I was reciprocal, that would be very tough for people.
Investors getting a boost, and there might be more to come as a Republican tax plan begins to come together.
There's no daylight between House and Senate Republicans. We are one team. We have to bring stability to the markets. We've got to make sure everybody's tax rates are locked in, and they know that.
Clarity can't come quickly enough as consumer confidence continues to drop, falling to the lowest level in more than 4 years. The soft data is still looking soft.
Right now, it looks like the market is looking past the soft data, and certainly a number of Fed officials are as well. What we saw is Fed Chair Jay Powell dismissing some of the soft data as not necessarily predictive of what's to come. And we heard some things, similar yesterday from both the Fed's Williams and Goolsbee. Question is that sort of what we're going to be looking at going forward? Is this the new tone, or is this a brief reprieve at a time where suddenly there's more of a nod to markets?
There's definitely been a tone shift in the last 24, 48 hours, and now we can get hopeful, can we, about a tax plan coming together down in D.C.?
Treasury Secretary Scott Bessent says that potentially yes, because they're going to see a swift resolution when it comes to how the House Republicans and Senate Republicans are looking at the tax bill. I would say yesterday is a good start. This timeline, very aggressive. They want this done before the summer. There's two reasons why maybe they can get there before the summer. One of them, the most pressing, is the fact that they're under pressure because of tariffs and what you're seeing in the soft data. And two, because there's a debt ceiling looming in the summer. And Donald Trump, the president, wants to see the debt ceiling negotiations come together with this reconciliation package.
This has been the strategic anchor around a bullish view for a number of months now, that when you take a step back in 12 months' time, the fuller policy platform has a bullish mix to it. Pro-growth, pro-risk. Taxes, though, are a big part of that story, and that's the development we need to see in the next several months.
And it seems like the GOP is moving pretty quickly, although this is what I'm really wondering. Looking forward, you take a look at what this plan is. It's kicking up the debt ceiling limit, potentially by $4 trillion. And And it's including $4.5 trillion of tax cuts with $2 trillion in spending cuts. That increases the deficit almost $3 trillion over the next 10 years. At what point does that become the main theme, particularly for debt markets that seem to worry more about things like that?
A three-day winning streak on the S&P. No worries over the last 3 days. Equity futures this morning down just a touch. We're negative by 0.2%. Coming up this hour, Marvin Lowe of State Street with stocks on a three-day winning streak, and Rita Sen of Energy Aspects as Russia and Ukraine agree to a Black Sea truce, and Max Kettner of HSBC going underweight the US across the board. We begin this hour with stocks looking for a fourth consecutive day of gains. Marvin Lowe of State Street writing, there is a life cycle to market uncertainty where investors get to a point that most outcomes become reflected in valuations. We think that is increasingly the case with tariff risk. Marvin joins us now for more. Marvin, good morning. Good to see you. Can you ignore consumer confidence and the soft data of the past few weeks?
I mean, you can't ignore anything. I mean, we have to absorb the data. What we can do is realize that there's such a disparity in how that data is coming in, based on partisanship, if you will, and the administration's ability to effectively dominate the news cycle has to be playing into psyche. So maybe, for me, the importance of the soft data is not as great as the hard data. I think we're hearing that from Fed officials, and to a certain degree, it's like I'll lean on hard data always over soft data, but, it needs to be seen, and a lot of the things you talk about in terms of resolution to these concerns is part of that story.
We've spent these past few weeks asking who would blink first, the Trump administration or Chairman Powell and the Federal Reserve. Did we get the answer to that in the last 24 hours?
I think to a certain degree the Fed blinked. Having said that, they are very much leaning on those growth concerns. So they're not necessarily taking the administration tonic as gospel in terms of what it's going to do to growth.
Do you think the positive tone is because the Fed blinked or because the administration blinked? Because right now there does seem to be a different tone, to John's point. And this comment, which we just heard earlier from House Speaker Mike Johnson, we have to bring stability to the market. Suddenly there is an expediting of that tax plan. How much is in recognition of some of the instability that we've seen in markets?
Yeah, you know what? Certainly the sliver of a Fed put is powerful. And the economic projections, despite the fact that it's showing that the Fed has no idea, the way the market has no idea, is an important change in market theme. Having said that, there has been a change in the tone of the administration. So, what is more powerful? They both came together at the same time.
There have been a number of people who came on the show and said, this is just a momentum trade unwind, and now we're kind of dealing with the other side of it. Maybe we've readjusted positioning and can now trade more on fundamentals, whatever that means. I was noting yesterday that VIX fell to the lowest in about a month, and we saw Mag 7 up 6.2% over the past 3 trading sessions. Yesterday, equal weight was down. Are we basically reverting back to the momentum trade in a way after it getting washed out?
So I do think wash out of positions was an important theme in the first quarter. We're much more balanced, whether we're talking about it from an equity perspective, a currency perspective, not necessarily on the fixed income side of things, which continues to express concerns that the other markets haven't gotten into. Bond guys were always a bit more worried than anybody else in the room. It does give the ability to these large institutional investors to go either way. I don't think they're ready to go there yet because we still don't have that clarity, but that washout in positioning was an important theme that, we understand from a technical perspective in our seats versus, what's going through the headlines.
Are we going to get clarity next week on Liberation Day, April 2nd?
You know what? Whether or not we get the full amount of clarity in terms of what a potential end game is, I don't think that matters as much. I think what we're going to see is the administration is moving forward with fairly aggressive tariffs, much more so than we thought in the first quarter, and we're okay with that because we understand that a bit more now. It's really the retaliation or retaliatory aspects that might evolve, which will keep the market off sides, and the fiscal side of it. That's the discussion in the second quarter going into the third quarter.
When it comes to the tariffs, though, why do you think that they're going to be very aggressive? We had the Europeans yesterday. Mexican delegation will be today. They're having negotiations before April 2nd, and Donald Trump said last night on Newsmax he's willing to be lenient when it comes to tariffs.
You know what? They need the revenues, number one. So, there isn't as much room as saying just going away. The CBO released some data about what the full suite of potential administration policies would do to the deficit, and they're frightening. So they need the revenues, number one. Number two, they're going down a route that is, from an aggressive perspective, much more than the easy, soft touch that I think we entered the year in, that this administration, from a tariff perspective, was going to look like 2018. And clearly, that's not the case.
You believe this is about raising revenue?
I think it's part of the discussion, for sure.
Canada, Mexico, raising revenue, or something else?
Canada and Mexico has to be part of the equation because they're such large trading partners. Europe has got to be part of the equation because they're such large trading partners. Are there side goals associated with that? Yeah, I'm sure there are. European defense spending. I mean, we've gone down a route that ultimately no one would have expected 6 months ago. So, you know, they're getting a lot of what the administration wanted back in 2016, 2018 by pushing this tariff discussion.
For the market, how important is it for these two pillars to be side by side? April 2nd tariffs, end of May, a tax extension.
They are part and parcel. The debt ceiling is out there. We've got just a litany of stress points when it comes to, you know, the dollars and cents.
Do you think it's enough, though, for this tax bill to just be an extension of TCJA and no other extras?
Well, you know...
like, how does the market get excited about status quo policy that we have current day?
Yeah, it's really a function of, I think, how the debt market absorbs that information. The debt sustainability, you know, story, it comes and goes. But the fact that the 10-year is still kind of in this mid 4% range, where we're talking 4.25%, 4.5%, is unsustainable from a funding perspective. It is really, really important, and I think it's why we hear the administration talking about the 10-year as much as they do.
I'm so glad you went there. Today, $70 billion of 5-year notes being auctioned off at 1 p.m., and tomorrow we've got $44 billion of 7-year notes. At what point, if the budget as is goes through, do bond investors start to worry once again about funding issues?
I don't think the worry went away. I think if we're talking about recession, if we're talking about a Fed that's really putting a small put on the table because they're worried about growth and worried about recession, you would normally get a much more aggressive reaction coming out of the bond market.
You know, it strikes me, and we were talking about this yesterday, that stock markets are worried about tariff risks, and the bond market is worried about this budget and tax cuts and trying to understand exactly how this goes through. Do you think that potentially the bond market is going to be much more volatile over the next few weeks and months ahead as these budget negotiations really get going?
Yeah, I do think so. I do think so. Term premiums really haven't expressed any degree of concern, even relative to what we saw a few years ago when we started really talking about the amount of debt that needed to be termed out. There is a risk to really relying on the short end as much. I mean, you talk about auctions, you know, in a way that's quite cohesive to just the risk that we're taking. That creates volatility.
Marvin, appreciate your time. It's good to see you, sir.
Thank you.
As
Nice
always,
seeing you
Marvin Lowe there of State Street. Lisa taking us to the bond market. Yields just a little bit higher today, up by a basis point. The 10-year still in and around 4.30. Let's turn to your Bloomberg brief, an update on some of our top stories worldwide. US, Russian and Ukrainian officials announcing a ceasefire in the Black Sea, but Russia saying the deal is conditional on sanctions relief. The ceasefire ensuring safe navigation and preventing the use of commercial shipping for military purposes. Elsewhere, Republican leaders saying they're close to agreeing on a plan to extend President Trump's 2017 tax cuts and increase the debt ceiling. House Speaker Mike Johnson saying the Senate counterparts are, quote, coming around. And finally, Dollar Tree is nearing a sale of its Family Dollar business to a group of private equity investors for roughly $1 billion. The Wall Street Journal reporting a deal will be formally announced as part of Dollar Tree's earnings report out later this morning. That stock is higher by 6%. Up next on the program, a softer tone emerging from the White House.
Not too many. Not too many exceptions. No, I don't want to have too many exceptions. We're just going to be reciprocal. In fact, I'll probably be more lenient than reciprocal, because if I was reciprocal, that would be very tough for people.
A shift in the last 24 hours. On that shift, Jeanette Lowe of Strategas, the Baird Company, joins us next. Live from New York City this morning. Good morning.
has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Three-day winning run on the S&P 500, the longest daily winning streak going back to early February this morning, just a little bit softer. We're negative here and down a little more than 0.1% on the S&P. On the Nasdaq 100, softer by 0.2%. Under surveillance this morning, a softer tone emerging from the White House.
Not too many. Not too many exceptions. No, I don't want to have too many exceptions. Yeah. I know some people say, oh, do you think it's too much? Well, they've been doing this to us for many years, whether it's China or India or Brazil or so many other places. And all we're going to do, it's reciprocal. We're just going to be reciprocal. In fact, I'll probably be more lenient than reciprocal, because if I was reciprocal, that would be very tough for people.
So here's the latest this morning. President Trump indicating he may be more lenient than reciprocal, suggesting a softer than expected touch when he unveils additional tariffs on April 2nd. Bloomberg's Tyler Kendall joins us now from the White House for more. Tyler, what do you make of the shift of the last 48 hours?
Yeah, well, good morning, John. President Trump's comments suggesting that the reciprocal tariff plan on April 2nd might not be a tit-for-tat response when it comes to the current trade barriers, despite this White House always saying that what they charge us will charge them. Our reporting still indicating that the White House is likely to focus in on that top 15% of trading partners who make up the bulk of the trade imbalance with the U.S., even as he says that exceptions are going to be rare. Important to note that President Trump did go on in that interview to say that sometimes so-called friends are worse than foes. He singled out the European Union, perhaps giving us some insight into how that trade talks went yesterday with the EU trade chief and senior administration officials. I also wanted to point out the context of this question that President Trump was answering. He was asked whether or not how high his tolerance was when it comes to an adjustment period in the economy due to tariffs, and the interviewer had suggested maybe that's why he's going to give exceptions, and he said, well, no, not too many exceptions. A senior White House advisor, Stephen Myron, was on Bloomberg Television earlier this year. He also, earlier this week, excuse me, he also said that he felt that tariffs weren't going to contribute to this adjustment period, and rather the reorientation, as he called it, was from moving from a government-driven economy to a private sector-driven economy. John, as you know, this, of course, comes as those consumer sentiment data numbers hit 4-year lows yesterday, with the Conference Board writing that it was partly due to tariff concerns.
Tyler, another pillar of the Trump agenda, of course, is the tax cuts. And we got some insights yesterday about how those negotiations are going. And for the first time in a while, it does seem like House Republicans and Senate Republicans are on the same page. What happens next?
Right. Well, Anne-Marie, there's still some big hurdles that they do need to cross, and we should caution that it is still very early on, even as we do get some positive signs from leaders yesterday after they emerged from their meeting with Treasury Secretary Scott Bessent and NEC Director Kevin Hassett. The two big things on the table that they still need to tackle, whether or not a debt ceiling increase will be included in this bill, as well as those top-line numbers. There does seem to be some disagreement, particularly about that $4.5 trillion tax cut blueprint that's currently baked into that House plan. We know that Senate Republicans would like to see that number larger so that they can make permanent those 2017 tax cuts. And then there's disagreements about the spending cuts. $2 trillion is what's currently factored in, but Republicans are already raising concerns about what that could mean to some social programs like Medicaid.
Hey, Tyler, appreciate the update. Tyler Kendall at Bloomberg down in Washington, D.C. We'll hear more from Tyler later on this morning. Tyler mentioned consumer confidence. Consumer confidence dropping to a 4-year low. Expectations 6 months out, the worst in some 12 years. Inflation expectations, the highest in 2 years, and expectations for personal finances the lowest since July 2022. Certainly compared to expectations coming into 2025, The White House and this administration moving harder and faster. Jeanette Lowe, strategist of Baird Company, writing, when we added up what has already been announced in terms of tariffs, we found that it would be a $235 billion impact over 12 months, or 0.7% of GDP, which is more than many investors were expecting. Jeanette joins us now for more. Jeanette, welcome to the program. Certainly surprising how hard and fast they've moved since they walked into the White House. Are you seeing any signs over the last couple of days that maybe they're just softening their tone, just maybe backing away a touch?
Yeah, absolutely. I think they are trying to start to walk back a little bit. I think there hadn't been a lot of numbers put out there of what the actual impact was. And so we really tried to take what has actually been levied already on China and Canada and Mexico and with steel and aluminum, and then add in reciprocal tariffs and then sectoral tariffs. And I think that number started to surprise some folks. And if you see all of that coming in at once, that can actually be negative for the administration. Now, obviously, we're still getting mixed signals, so we don't necessarily know, will some sectoral tariffs on maybe autos still be announced? That is kind of up in play. And you also we have reciprocal tariffs that is just focused on higher rates that other countries charge. But then the administration also wants to include what those countries charge in VAT taxes and put that into the equation, and some other non-tariff barriers. And that, I think, is the question. So they need to kind of figure out what pieces do they actually want to include, and then how that actually can be structured, because it could be quite a shock if we come on April 2nd, depending on what is announced, if they don't pare some of this back.
Well, when you mention VAT, I immediately think of the European Union, and the Commissioner for Trade yesterday is all smiles, standing alongside Howard Lutnick and Jameson Greer, Kevin Hassett, after their intense negotiations, what he's calling it. And he says the EU's priority is a fair, balanced deal instead of unjustified tariffs. Do you think he's going home to Europe with a deal?
Yeah, I mean, so this is what's interesting, because I think, we did hear some talk about lowering the tariff rate on autos, and also trying to get the U.S. to lower its tariff rate on pickup trucks. That's something that obviously can be done, that has been a bone of contention for President Trump for some time. But I think you also have to really watch this VAT piece, because I think overall, if you look at just applying higher tariff rates on European goods, it's not going to be as much of a significant impact. If you start to add in VAT taxes and that impact, that's much higher of an impact on the European Union. And it's also more difficult for them to change that. They're not going to be able to easily change those taxes for the Trump administration. So it's harder to see where that negotiation could come into play. And I think that's going to be important as we move closer to April 2nd and get more details.
When we get more details on April 2nd, what kind of tariffs do you think we will see immediately? And then what other legal measures will they rely on that will take weeks or months, say 232 or 301?
Yeah, I mean, I think that they are going to try to announce several reciprocal tariffs immediately. Now, I think the question is it a 30-day implementation period, kind of like what we've seen for some of the other pieces earlier this year? But it might be more on select countries. So they're not going to probably go for a universal tariff, which is what they were talking about doing earlier this year. We've moved much more from that universal tariff to this reciprocal piece. If it's reciprocal, it can also be country by country, which means maybe you can apply it to a handful of countries at one time, and then add in other countries down the road, allows for more negotiation and that piece. Trump has also been talking about, that he wants to do tariffs on autos, and he says that he's going to announce that soon. If you add in a VAT on the EU, that kind of also hits the European Union on autos, particularly Germany. It would hit Ireland in terms of pharmaceuticals. So that's going to be an important piece. And I think the other thing that's really important, too, is what happens with Canada and Mexico. There are significant tariffs right now if we're talking about whether or not goods are USA compliant or not. And are those changed on April 2nd? And do they go just to reciprocal tariffs, which is much more manageable? Or do we have reciprocal on top of what has already been announced for Canada and Mexico? And that could actually be much more burdensome and much more troublesome for the market.
I feel like we're all trying to put together a tariff puzzle and figure out what pieces people are saying and then put it in its correct place. And if we were creating that kind of puzzle, where would this copper tariff piece really get put yesterday when President Trump announced that he is going to put tariffs on copper and has previously discussed something like 25% of all incoming copper imports?
Yeah, I mean, so this is something that they are trying to rush, right? So usually you have 270 days to do this kind of investigation. And this is something that he did with steel and aluminum. So, but it follows at least a little bit more of a process with regard to having input from the public and from companies that would be impacted. But I think this is something that he is trying to target certain areas. And he feels like the steel and aluminum tariffs, you saw that we now got rid of the exemptions. With copper, that could be a similar story. It also could be potentially somewhat of a negotiating tool if you can announce it, and then it kind of hits certain partners and there's an opportunity there. But it seems like with the commodity tariffs in particular, Trump looks to be looking to focus on putting those into place and not allowing as many exemptions. So that's something we're definitely going to be watching going forward.
Jeanette, there has been this shift in tone more generally, and John started the show talking about it. We've been feeling it in terms of market performance, and we're hearing it not just from the White House and tariff negotiations, but also from the House, with House Speaker Mike Johnson coming out yesterday saying we have to bring stability to markets, saying that negotiators around the budget, not necessarily tariffs, need to give people certainty so that they can, quote, make decisions about expanding their businesses and jobs. How much are we hearing a kind of around the table feeling of concern about the uncertainty in Washington, D.C. that is a material shift than, say, even a couple days ago?
Absolutely. I definitely think that this is definitely a part of the conversation for policymakers. And if you think back to the first Trump term, you had them passing a tax bill first and then going in and putting on tariffs primarily on China. So they were much more modest in scope than they are today. And that created a cushion for the market. This time we have the opposite. We have tariffs coming into place first. We're not obviously going to have a tax bill done by April. So you're going to have that more difficult piece coming in first before you get some of that fiscal policy to help balance it out. I think you do see members of Congress thinking about what will be the tariff impact and thinking about, do we need to include some more pro-growth tax policies within that tax bill? So kind of bringing back the R&D, immediate expensing, having 100% bonus depreciation, doing that potential 15% tax rate for domestic manufacturers, potentially even other pieces. So I think they're going to have to start thinking about those proposals, and I think they are currently, and how they get structured. And then as we get the tariff announcements, that will give them more to know what they need to do moving forward as that tax bill actually gets built.
Jeanette, appreciate your time. As always, Jeanette Lowe there, of Strategas, a bed company, on the latest push down in Washington, D.C. I think a lot of you saw the consumer confidence number and made a similar observation. Consumer confidence at a 4-year low. Those numbers are worse than when inflation was north of 8%, approaching double digits, and the Federal Reserve was hiking aggressively. That's how much consumer confidence has softened up over the past few months. Up next on the program, we'll talk about energy. Amrita Sen of Energy Aspects, as Russia and Ukraine agree to a ceasefire in the Black Sea.
one of the very critical things is that a lot of young entrepreneurs don't realize is that when you start as an entrepreneur, you're not just building your business, which of course you are, but you're also building your organization. And most people don't realize that. And building an organization is not just about hiring people. It's about the culture, it's about the systems, the values, the mission. You know, it's about how you operate, how you do things, how you retain people, how you keep them motivated. So it's all of those things put together. And over time, you realize that, you know, a lot of effort has to go into it. And then eventually you have an organization that has a life of its own. It's, you know, and it's sometimes you look at it and you marvel and you think about, you know, how was this created? And was I the person that was behind getting this thing done?
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Equity softer here, following a 3-day run of positive S&P 500 moves. We're down by about 0.1% on the S&P. On the Nasdaq 100, we're down by 2. Later this hour, 15 minutes away, Max Kettner of HSBC going underweight U.S. risk assets. It's no longer about Goldilocks, but whether the sentiment shock will spill over into the hard data in the United States. That conversation, 15 minutes away. With 3 hours until the cash open, let's get you some morning movers and cross over to Danny Berger for more. Hey, Danny.
Hey, John, we have a couple movers to get through, but in earnings. But it's not really earnings that is moving the stock, at least for GameStop, because they reported earnings where sales plunged 28% year over year. Instead, it is a separate announcement from GameStop saying that they are going to be adding crypto to their reserves, specifically Bitcoin. They're going to be holding that as a treasury asset. And again, this stock is one of those meme ones and gets people excited with these sorts of announcements. So those shares up nearly 13% in the pre-market. Now to the downside, NVIDIA down 1% this morning. A story from the FT really interesting that China is looking at placing environmental curbs, which would mean that NVIDIA's chip, especially tailored to the Chinese market to overcome U.S. curbs, would not be allowed to be used and sold by the tech giants in China. Of course, it's not being enforced, that ban, quite stringently, but if it is, it would have huge implications for NVIDIA. Finally, rounding things out this morning with Dollar Tree, we should hear from them for their earnings this morning. We don't have that yet. Will be interesting to see what the consumer is doing. See some back and forth, up 0.5%. Dollar Tree going to be selling one of its assets to a consortium, its Family Dollar business, a consortium of private equity. That deal for about $1 billion, John.
Danny, thank you. Appreciate the update. More from Danny in the next hour. On our radar this morning, the Mexican economy minister set to visit Washington today for trade talks with U.S. officials. The visit coming just 1 week before President Trump's Liberation Day, when he's expected to announce reciprocal tariffs on trading partners.
So I thought it was very interesting last night, this tone shift, Jonathan, you've been talking about. Trump said he'd probably be more lenient than reciprocal. And what we've seen all week are meetings after meetings with trading partners. Today, it's Mexico. Yesterday was the European Union. The European Union trading commissioners talking about the fact that this was very intense negotiations and they like to get to a deal. There's also negotiations happening with India. So potentially before April 2nd, Trump is going to come out, starting at a maximalist approach, but come out and say, I was able to strike a deal. It's not as aggressive as we've been talking about, but it's reciprocity, which really is the buzzword for this administration.
I want to understand how the Mexico negotiations in particular had to do with cars, considering the fact that they came with respect to this Made in America electric bus, Made in Mexico electric bus tour. It's a question right now that I'm wondering, is Cliffs idled one of their factories as a result of a lack of U.S. auto demand? It's just a lot of moving pieces, and how this factors into the negotiations still is somewhat of a mystery to me.
Things are lining up for a much more market-friendly outcome in the next week or so. But as we've said repeatedly on this program, things can move the other way just as fast. Yes, we've had a softer tone from the president. Yes, it's encouraging that we're actually seeing trade officials from Europe, from Mexico, come to Washington and negotiate. But I'm not sure how much weight, how much trust you can have in the idea that that sentiment shift we've witnessed over the last 24 hours or so will actually stick.
That's true. We need to actually see what they come out with on April 2nd. But at the moment, I think it's fair to say the bark we saw when they entered the White House is not going to be as harsh as the bite we might see on April 2nd. What is interesting, though, and I think Marvin was getting to this point, Trump 1.0 was about China. Phase 1 trade deal, heavily focused on agricultural and goods. Trump 2.0 is the rest of the world. It's everyone else, including America's closest trading partners.
Let's talk about the rest of the world. The United States announcing that Russia and Ukraine agreed to a ceasefire in the Black Sea. The Kremlin confirming the agreement, but saying sanctions need to be lifted on banks and companies involved in agricultural exports. So which one is it?
I think it's the Kremlin looking for any more concessions they can get. Vladimir Putin is also going to deal with Donald Trump in a maximalist way. What caught my eye yesterday was actually the Director of National Intelligence coming out with the latest unclassified assessment. And they said that when it comes to Ukraine and Russia, quote, leaders for now probably still see the risks of a longer war as less than those of an unsatisfying settlement, meaning they rather drag their feet. As Donald Trump said last night in this Newsmax interview, I think that Russia wants to see an end to it, but they could be dragging their feet before they come to an agreement. In this moment of a negotiation, they're both going to come in, and specifically Russia, given they have 20% of control of Ukrainian land, with a maximalist approach.
I guess what is a maximalist approach? It's that we're not going to do anything until you lift all sanctions, and that's Russia. And it raises the question of just how quickly Russia can reacclimatize to the global trade system, and whether that's actually in the offing, and whether the European Union will really get on board with that.
I can tell you the max bullish outcome of all of this, if they back off on trade, if we get a deal in Ukraine, if we can get any prices lower and then focus on this, taxes, then things could be in a much better place. Republican leaders saying they're close to agreeing on a tax cut plan. House Speaker Mike Johnson also saying the Senate is, quote, coming around to supporting a debt ceiling increase as part of the legislation. All of that is starting to sound a little bit better compared to where we were a week or so ago.
So now that the debt ceiling is part of this means that they have a serious timeline. What economists will tell you is that we're going to hit that X date on the Treasury when they can't pay their bills by maybe the middle of the summer to early fall, which means if they are going to include debt negotiations part of reconciliation, they have to get it done by September, really the latest, but they're being very aggressive. They want this done by Memorial Day. Now, it all sounds like happy talk coming out of the Treasury Department yesterday in this meeting that Scott Bessent held, the Treasury Secretary. I will say there's going to be a number of senators that maybe Donald Trump himself needs to start whipping their counts. You look at someone like Senator Ron Paul. He came out and he said, they lost me. I'll never sign up for a deal that includes increasing the debt ceiling.
The focus is slowly shifting. Let's shift the focus back to commodities. Oil edging higher following an industry report which signaled a large decline in U.S. crude stockpiles. Traders also weighing the prospect of a Russia-Ukraine ceasefire in the Black Sea. And Rita Sen of Energy Aspects joins us now for more. And Rita, welcome to the program. Let's get to that potential ceasefire that we could see between Ukraine and Russia on a much larger scale. What would that do to energy prices? What would that do to the flow of energy?
Firstly, I don't think we're going to get a ceasefire anytime soon in the true sense of the word, like you guys were discussing. I think there'll be a lot of noise. And I think we have to remember that both sides, Russia and Ukraine, are going to thread this kind of line where they all appear very positive and, you know, all the outcomes are very positive. But if you actually look at it, nothing has moved. I think the positive spin we are seeing out of DC on very, very minimal gains has been impressive, no doubt. But if you actually read through the details, there has been no shift from either side on their red lines. And I think that's the critical thing. Remember, the headlines will have to put a positive spin so that neither side angers the current precedent. I think we need to look at the whole thing through that lens. In terms of sanctions lifting, remember, we haven't lost any Russian oil because of sanctions. India and China continue to buy that oil. Any Russian oil we've lost is because of OPEC plus policy. That's not changing. OPEC is going to continue to bring back barrels over the summer months. Russia gets a part of that. That's fine. Beyond that, nothing. One last thing, U.S. sanctions on Russia if they were to be removed without Europe going ahead, that is actually bullish for oil, not bearish, because the original European sanctions were designed so that Russian oil couldn't flow at all through Western shipping sanctions. The price cap was designed to allow that to flow. If you take away the price cap, the European sanctions kick in without this caveat, and therefore really no Russian oil will be able to move other than in the dark fleet. People forget that.
Amrita, are they even enforcing the price cap right now, though?
No, but the whole point is the price cap gives you the ability, you can claim whatever the price it is, but you can say, oh, because of the price cap, we are able to move it. If you take the price cap away, the European sanctions say they cannot use any Western shipping or insurance services. That's the critical thing, because at least the price cap gives you a way to get away from it.
When it comes to other potential energy flows we can see, if they were to get closer to a ceasefire agreement, Sergei Lavrov, talking to TASS News, Russian state media yesterday, said that Nord Stream, there is talk of Nord Stream coming back online. Amrita, what do you make of that?
I think, again, there's going to be a lot of noise, a lot of headlines in terms of, again, gas. I think it is going to be more important for gas than it is for oil, just given the volumes lost, right? Like I said, oil we haven't lost. But we keep forgetting this is Russia also trying to create a wedge between Europe and the US. And that's why certain statements like that of course, we're going to bring Nord Stream. And by the way, Europe, you need our gas. Europe has a big say in this. And the European sanctions are actually the main sanctions on Russia, much more than the US ones. It's the opposite for Iran.
But how much will European gas actually be helpful to Europe? I mean, although Europe has a lot of tough rhetoric when it comes to Russia, they're still importing Russian gas.
Oh, yeah. And look, I think this is the biggest question mark that I don't think anybody will have a true answer to, in the sense that we are losing so much industrial demand, and we have lost, I would say, 15% of gas demand we believe is never going to come back in Europe because of the high gas prices and the relocation of industry to places like the US. So the question then becomes, yes, Europe is talking about more renewables and kind of tripling down on it, but if it's, again, not our base case, but if you suddenly start to get a ceasefire and sanctions get removed, does Europe actually change that? We do think some European countries will go back to Russian gas, but we're not going to get the volumes back anywhere close to where we used to be pre-war.
Are you saying, Amrita, that if there is an end to the war between Ukraine and Russia, that it will have an immaterial effect on the price of oil?
What's going to happen is that Russian differentials, which now trade at a discount, will go up because Russia no longer needs to discount its oil, right? Because right now it's having to discount to clear. But on a volumetric basis, no, because Russia is already producing as much as it can within the OPEC Plus framework, is just sending it to China and India.
Before we let you go, I do want to get your take on copper and what we heard overnight from President Trump and the likelihood of pretty aggressive tariffs on copper, this goal to bring manufacturing back to the United States. Shipbuilding is a big piece of that. That's also a part of the steel and aluminum tariffs. How much does that shift the cost of copper in the United States? We've seen a real departure of what's traded in the U.S. and what's traded on the London's Metals Exchange.
Yeah, and I think this is, it's not just copper, like you mentioned, steel and aluminum. Look, I'm in the Midwest myself. I've been meeting with a lot of the producers, including some who were in the meeting in the White House just last week. And I think the shift in metals prices is becoming a real talking point for both upstream and downstream. And shipbuilding is, I'm including them in the downstream. Just in terms of, like, certain producers are telling me their costs raw material costs have gone up anywhere between 15 and 20%. And I think that's why you are going to get that price discrepancy between U.S. metals markets and the rest of the world, simply to kind of basically price that in. And I think metals markets are going to go through this huge period of volatility until we have more clarity on the 2nd of April.
Amrita, appreciate your view. Thank you. Amrita Sen there of Energy Aspects. Need to get some news for you, some breaking news as well. Here is your Bloomberg brief. We start, first of all, with Dollar Tree. Fourth quarter net sales falling 42% year over year. This as the discount chain formally announces it will sell Family Dollar. Dollar Tree expecting net proceeds from that sale to reach $804 million. Elsewhere, U.S. consumer confidence falling to its lowest level in 4 years. The Conference Board's measures showing concerns about the economic outlook under President Trump's tariffs. And finally, the U.S. Treasury planning to lay off a, quote, substantial number of employees as part of Elon Musk's Doge efforts. The Treasury hasn't made final decisions on the layoffs yet, saying they'll be tailored to each bureau. And that right there is your Bloomberg Brief. Up next on the program, uncertainty all around.
We've seen a really large and pronounced pullback in both business and consumer confidence.
Uncertainty around policy that has crimped our forecast.
Commentary on the outlook is as wide as I've never seen it.
Up next on the program, Max Kettner of HSBC in the last 24 hours, downgrading U.S. equities.
The Vivian Tom clientele.
Yeah, power women, like the dragon women. They're lawyers, they're CEOs, they're all important decision makers, women in the world.
Why do you position your products for this group of women?
When I started, designing, I always want to do something that is empower women.
When you take a look at your store, there is something for everyone. Take a look at the T-shirt, for example.
My customer growing, like 30 years already, so they become more powerful. I also want to grow my Gen Z audience too, They are like in the 20s, so it's a more affordable price for them. And then, my powerful woman's daughter wearing their mom's dresses, and they feel the power, the energy. So now they come back to the store and they buy more.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Things have been so choppy that we haven't seen a three-day run of equity gains since February 6th. On the S&P 500 this morning, we come back just a touch. We're down by not even 0.1% on the S&P 500. Similar amount on the Nasdaq 100. Under surveillance this morning, uncertainty all around.
We've seen a really large and pronounced pullback in both business and consumer confidence.
Uncertainty around policy that has crimped our forecast.
Commentary on the outlook is as wide as I've never seen it.
Given the kind of kneecapping that we are going through from a policy standpoint, that raises the risk of a potential slowdown.
So here's the latest this morning. Uncertainty is pressing on global sentiment with a week until President Trump's April 2nd tariff deadline. Max Kettner of HSBC downgrading U.S. equities to underweight and writing economic and political uncertainty is unusually high, but dismissing the U-turn in leading indicators and price indicators as a one-off or outlier seems quite far-fetched to us. Max joins us now for more. Max, welcome to the program. This is a significant change for you, and I stress for people who aren't familiar with how you've called this market over the last year, you are no bear on stocks, no bear on high-yield credit. You've been bullish when it was the right time to be bullish, and now you've made a move to go in a different direction, Max. So let's take a step back and think about why. What is it that you see that tells you that this uncertainty will persist?
Yeah, good morning. Look, I think what the difference now is to perhaps a month or two ago, we could have dismissed it as pretty much only consumer sentiment. We could have said this is pretty much driven by a political division. It's not something that is broad-based. It's just a couple of surveys, just a couple of soft data, particularly on the consumer side, and it's driven by one particular thing, so you can dismiss it. What's changed, I think, now is we see a much more sort of broader-based slowdown among all the soft and the survey data. You look at, for example, CEO confidence. We had the biggest one-month slump since September 2008. I think we all know what happened there. You know, you've got in the Philly Fed, you have the biggest 2-month drop in new order expectations in history. That series goes back 55, almost 60 years. We've got the biggest 2-month drop rate. You know, it's not just, it's on the labor market as well. You look at consumer expectations, consumer sentiment on labor market conditions, clearly looking for negative payrolls there. You look at challenger job cuts, clearly biggest jump there since COVID. So my concern is that people are focusing in the hard data. They're looking at the hard data from January, and they're saying, you know what, that's holding up, so let's dismiss the soft and the survey data. But I do fear that we've seen too much damage, and especially too much broad-based damage in the survey and the soft data in order to just dismiss it as a one-off.
So underweight stocks, underweight high-yield credit, underweight investment-grade credit. Is this a bet then, Max, that this is going to show up in the hard data in the next few weeks and months?
Yes, absolutely. I think what we've done is essentially we've introduced a big sentiment and a big confidence shock into a U.S. economy, which actually has been picking up and has been improving in the second half of last year. When you look, for example, at the labor market, remember payrolls, people were saying, well, it's just government and healthcare jobs. Well, in fact, when we look at the second half of last year, the net number of industries hiring was picking up. So even the labor market breadth was actually improving. And we've seen a lot of sequential numbers which actually were improving in the second half. So it's a bit like, you know, we've boarded a train that's been improving and been running in the second half of last year, and now we're suddenly introducing a confidence and a sentiment shock. So to me, I don't think this will take 3, 4, 5 months. I don't think this is going to be a recession that is going to be, you know, basically coming sometime in the second half. I do fear that we might get a pretty sharp slowdown in the data very early on and very, very soon.
Well, which raises the question of how much this is a challenge to the entire U.S. exceptionalism bet. And I know this is a tired horse at this point, but it is essentially what you're saying. It's dollar assets. It's a reversal of that trade. How much is this hinged to what's going on elsewhere?
Yeah, look, I think on the U.S. exceptionalism case, however, that is, you know, a question of cyclical, tactical versus structural. So it's really a case, or a question of, are we completely putting to bed the idea of U.S. exceptionalism? Are we putting to bed the idea of U.S. companies having much better return on equity, much better corporate profitability compared to European, Japanese, EM, basically rest of world companies? That is a structural issue, and that is not going away. So this is not a call on the end of U.S. exceptionalism. I think it is much more a call of perhaps sort of a near-term, really pretty bumpy ride in terms of hard data following the broad-based decline that we've seen in the soft and the survey data. On a more longer-term structural issue, I really doubt that we're going to get sort of a structural strategic shift away from U.S. assets into European assets, into rest of world assets out of the U.S. I heavily doubt that, because for that, the relative profitability picture in the US still looks much better. And let's not forget, the liquidity and the depth of the US market is still nowhere near where the rest of the world is. The rest of the world cannot compete with that, with what the US has to offer there.
Which is the reason why, Max, I understand the U.S. equities call. I don't really understand the U.S. debt call. If you think that growth is truly going to sharply slow down, why not go into U.S. debt, particularly investment-grade debt, especially in favor of European debt, where the yields are still blowing out as a result of some of the borrowing plans from Germany?
I think, look, when we look at a more broad-based sell-off or a broad-based correction, I think that is going to look perhaps really similar to what we've seen in July, August, September last year, which was essentially a US-driven sell-off. It was a US-driven recession fear. It wasn't, remember back then in summer, we actually had the dollar sell off into recession fears because people were saying, well, this is a US-specific issue. It's a US-specific recession concerns. And that, I think, is very similar to what we're seeing right now, you know, where perhaps the dollar doesn't really play that much of a safe haven role. And I would say, look, the difference, what we're seeing right now to an absolutely crystal clear classic risk off is that there is stagflationary concerns as well. Let's not forget that in the last 4 months in the US, goods prices have been picking up. We know that, you know, prices paid have gone up in the PMIs. We know in the regional Fed surveys, when we look both on services, particularly in manufacturing also, price paid expectations are almost back on an aggregate basis to the level where we were at the peak in 2022. So there are these stagflationary concerns, which perhaps also put into question the US debt roll, so US Treasury roll as the ultimate portfolio hedge there. To me, the much clearer hedge here is gold. That's why we've even increased further an already really outsized overweight that we had in gold.
Max, when it comes to you, the most important thing that's really changed your sentiment, you say it's that since Inauguration Day, the administration's proposals have resulted in a sizable confidence and sentiment shock. What happens to the sentiment when potentially we get the entire package of the Trump agenda? Because right now what we see is there have a massive push in Washington to get the tax extension over the finish line.
Yeah, look, I guess that's part of the reasons actually why I'm concerned, because number one, what is the probability that beyond next week, beyond April the 2nd, we're putting completely to rest the tariff issue? We're no longer talking about tariffs at all. I think, you know, that probability is probably very, very low. I have very, very low confidence myself in calling what the actual measures are going to be, the actual targeted tariff measures are going to be next week. I have much greater confidence in saying, actually, next week, it's not going to be the end of tariffs. We're still going to talk about this, perhaps, you know, with regard to Europe, but also with regard to other jurisdictions. So that issue is not going to wait. That's number one. Number two is on the tax cuts. We still don't have the revenues. We're talking about a $7 trillion budget. And of course, you know, the last 2-3 months, the US administration has been talking about relentlessly cutting the budget. You look at the weekly outlays of the Fed, that's not happening. It's absolutely not in the numbers yet. We're not seeing that on an aggregate basis. The US is still spending the same amount of money that they've been spending year to date last year, the same amount. So I do worry if they want to bring the tax cuts over the line and also the tax extension of the 2017 corporate and income taxes. The worry that I have is that the bond market also is going to vote with its feet. And then we don't have an earnings-driven sell-off in equities and spreads. We have a multiple and a valuation-driven sell-off driven by the rates move, really.
Hey, Max, this is a change, sir, and it's good to get some clarity from you. Max Kantner there of HSBC. We have had a tone shift down in Washington, D.C. Whether it sticks, I don't know. But essentially what Max is telling you is it's a little bit too late. Sentiment has already shifted, and he's anticipating a drop-off in the hard data in the weeks and months to come.
When you take a look at the U.S. Economic Surprise Index from Citi, it still is below zero. When you take a look at the Citigroup European Surprise Index, it is the highest level since June 2024. It has been a steady drip down, and he is concerned about it.
Equities just about unchanged so far this morning. In the second hour of Bloomberg surveillance, Dan Greenhouse of Solis Alternative Asset Management, Tyler Kendall from Bloomberg down in Washington, D.C., Chris Marr of Ocean First Financial, Yelena Shulacheva of the Conference Board from New York. This is Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
What would you say somebody young who's watching this should do if he or she aspires to be like you?
There's one component of our industry that people need to focus on, and it's not technical, and that's communication skills. Focus on being a phenomenal communicator, invest in that. Think about it, we have to convince a company to sell to us. You just don't walk in and buy the stock or tell them, yeah, you're for sale, I'll pay you this price. That takes years of relationship and effort. Why would somebody sell you that billion-dollar software company growing at 20%? Just because? No way. People hang on to these great assets. And then how do you get on the same page with the executive team of that company, even if they're existing or new? It requires just amazing communication.
If you go to a cocktail party and somebody comes up to you and says, I have $100,000 I'd like to invest, what do you would recommend that person do with $100,000? What do you think is a good idea to do with $100,000 today?
Sometimes they do, and I give them the most boring answer ever. S&P 500.
Just buy an index.
Buy the index. You don't have to worry about the quarterly earnings of a company. Did something change? Did somebody change management? You don't have to make this your full-time job. Just buy the index and you're going to be okay.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
You'll see money rotate back into the U.S. and probably led back to the Mag 7 and some of these technology names.
On the 6 to 12 month horizon, we expect to go back to the U.S. taking the lead.
If you are a diversified investor, you actually feel good about having non-U.S. exposure.
I imagine the S&P 500 ending the year at about 6,000. But I think there's a lot of volatility ahead.
It's going to be important for investors to really dissect the signal from the noise.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Just moments ago, we caught up with Max Kantner of HSBC, downgrading U.S. equities to underweight. We've got a new one, Venu Krishna of Barclays, just catching up with Venu over the Bloomberg terminal, cutting the price target on the S&P 500, his outlook, down to 5,900 from 6,600 this morning, saying the second order effects incorporate the risk around growth and inflation off the back of tariffs. It's a downgrade from Barclays.
And when he was on with us, it sounded like he was about to cut his outlook, and we were saying, you could cut it right here. There is this issue of if you extend the x-axis, to quote Tom Keene, there is a prolonged feeling that this kind of sentiment shift downward will have ramifications, and that seems to be what people are talking about, in tandem with the unlikelihood of us getting a real kind of positive fiscal boost from some sort of tax package.
Barclays still don't expect recession. It's important to point that out, but they expect some weakness potentially in this economy. And certainly we've seen a sentiment shift, not just on Wall Street, but also in the last 24 hours down in Washington, D.C. from the White House. Is it too little, too late? Consumer confidence is a whole lot softer. HSBC thinks next up, it's the hard data. What we've heard from the president is maybe just a little bit of a shift relative to where they were in the past few weeks.
A shift, for sure, when it comes to the tone. But Jonathan's a good point. Max Kentner was making this point. Maybe it's a little bit too late when it comes to the tariff rhetoric, which we're already seeing show up in the surveys. What President Trump is now saying now is he's using words like lenient instead of reciprocal, like last night with Newsmax. He also recently talked about how he's willing to be flexible. And all of this rhetoric is lining up with tangible meetings. We have the Mexican economy minister coming to Washington today. Yesterday, we have the European Trade Union. They're talking to the Indian delegation. There are negotiations underway before April 2nd.
We need to get a bullish view. Coming up on the program, we'll catch up with Dan Greenhouse of Solace Alternative Asset Management as a softer tone emerges in the White House. Chris Marr of Ocean First Bank on the impact of tariffs on small business lending. And Yelena Shuletseva of the Conference Board as consumer confidence hits a 4-year low. We begin this hour with stock steady after putting together a 3-day winning streak. Dan Greenhouse of Solace Alternative Asset Management writing, the fact that some portion of the tariffs is being delayed underscores my more optimistic point. It's unlikely the worst of these tariffs are going to be implemented. Dan joined us now for more. Dan, good morning. Good to see you, sir.
Good morning to you, sir.
It's not just the soft data, so let's talk about the earnings. I know you've been focused on this. So Delta Airlines say activity stalled in the middle of February. Carnival Cruises have told us something completely different. So where do you stand on what the data's telling you and what companies are telling you at the moment?
So, listen, you said I'm more optimistic. And
based on that quote, you are.
Yeah, well, I did use the word, so I guess that's fair. Listen, I think at worst, the consumer's mixed. I look at earnings reports from Carnival, from Academy Sports, from Williams-Sonoma, from Darden Restaurants, all of whom told me something along the lines of the same thing, which is consumer sentiment has worsened, and we saw that yesterday, obviously, in the Conference Board number, but consumer activity still remains pretty healthy. And I think this ties into what you and Vinu were just talking about, because I pulled up his note. He's taking it down on the implementation of tariffs and the idea that this is going to weigh on earnings, et cetera, et cetera. His downside scenario is 4,400, which is about a 25% downside. Everyone is living in the future. This is going to be bad. This is going to be bad. This is going to be bad. And what I hear and see from the consumer is that, yeah, it might be, but it isn't yet. And so I'm taking a combination of A, the reality on the ground looks fine to me. And again, Darden, Williams-Sonoma, et cetera, told me that. Along with the belief that the worst case tariff scenarios are not going to be implemented. We keep talking about April 2nd as Liberation Day.
Sure.
Anne-Marie talked about this yesterday. It's unlikely that the full force of these tariffs are implemented tomorrow. A lot of the stuff is very nuanced and item specific, sector specific, and it's going to take weeks, if not months, to play out. Does that contribute to an environment of uncertainty? For sure, but it also increases the odds that country X does something sufficient to delay them even further. And so I'm going to hold out hope that that's the reality that comes to pass rather than some of these worst case prognostications.
Is that hope, that last point, based on the visits we've seen from the Europeans in the last 24 hours, from the Mexicans later on today?
Yes, I think it seems, listen, I think the Journal today has a story, Europe's wrestling with acquiesce or fight against Trump. I'm decidedly in the camp that you should just acquiesce. This is a losing argument for a lot of other countries, and for all the reasons that everyone's discussed ad nauseum. We're a relatively closed economy, import-export-wise, compared to China, certainly Canada and Mexico. You're much more reliant on the U.S. than is everyone else. That's not to suggest that this isn't some version of mutually assured destruction. However, I think it's much easier for a lot of these countries to just acquiesce to the president. And I would add, I was at a consumer lunch yesterday and made this point, and surprisingly, some people agreed with me. I can make the argument that tariffs are deflationary. What if I told you that the reciprocal tariffs are being put in place where I'm going to equitize tariffs with everyone else, and everyone else says...
Okay, I'm sorry, I have to interrupt here, because we've talked to a lot of people about this. We've said, what is the likelihood that this is going to result in lower tariffs? And they say, Donald Trump is tariff man. He wants tariffs. He wants the walls up. This is part of bringing manufacturing back to the United States. Have you seen anything credibly that makes you think that there will be some sort of grand deal where tariffs will be taken down and it will be true free trade?
No.
Okay.
Totally fair counter argument. I'm not saying that's going to happen. I'm saying I could make the argument. I'm not saying I believe it. But very quickly about that point, yes, I think it depends who you talk to in the administration. You guys surely talk to more people in the administration than I do, but you either believe that tariffs are a mean to an end, i.e. I want to get some behavioral changes from my trading partners, or you believe there's some national security issues at work here, in which case there's almost nothing anybody can do, particularly China, to counter.
I guess that what I'm trying to get at is, from a market perspective, have you gotten less confident in your bullishness as these discussions go on, and as you really question whether the genie's out of the bottle? That, yeah, you can say what people should do, but what they're going to do is going to be very different based on the sentiment that we're seeing in certain countries.
Have I gotten less bullish? I mean, listen, like anybody else, market action sort of controls my emotions. So to some degree, with the S&P down 10%, maybe I'm a touch less optimistic. That said, I look at Mexico's behavior at the border in terms of meeting some of the demands, in terms of cracking down on border crossings, et cetera, et cetera. Canada is obviously choosing to be a little more obstinate, but you look at what Colombia did and a couple of other countries in Europe. Or I think there's room for a middle ground here that isn't the worst case scenario. And while I agree that the administration, particularly the president, doesn't appear likely to want to cause a recession, I think he's willing to endure some short-term pain. But again, if you can reach an agreement, a reasonable agreement among parties, then some of these worst-case outcomes are not going to come to pass. And I think it's going to be much like the first administration, which was admittedly a different environment, where the worst-case outcomes also did not come to pass, and actually the equity market had a pretty good run.
But Dan, the first administration was focused on China.
I get it.
This time around, they're focused on a dozen countries, everyone. And there are knock-on domino effects of that. Okay, so maybe one country acquiesces, but France is talking about an anti-coercion instrument that you were talking about. The Wall Street Journal editorial board this morning came out to talk about. They might not acquiesce. The domino effects of that could hit margins.
Yeah, without a doubt, and this is why everyone's trying to find high margin, high pricing power type companies to insulate themselves from this environment. I'm not saying that everyone else is insane, and my scenario should be everyone's base case.
They might be.
By the way, definitively, at least half of them are insane.
You tell them.
What I'm arguing is there is an optimistic view here that doesn't get as much airing as some of the worst case prognostications. And again, I understand the broader implications here. I think there's a very good scenario that the market, I had been of the view since the January CPI report released in February that we trade sideways for some period of time. Obviously, the market then sold off 10% immediately. I didn't get that, but we're off 4% off the lows. I think it's just as likely that you trade sideways for another couple of months as it is that we fall into a recession.
The conference board yesterday, they talked about the write-in comments and how it's all about the current administration's policies, both positive and negative, and how that's dominating what consumers are thinking. So if consumers constantly hear tariff talk, could that not just be a self-inflicting crisis?
I think that's exactly correct. If you open up the Wall Street Journal, the New York Times, the USA Today, whatever anyone reads, all they're hearing is about how bad...
This might not end on April 2nd.
It definitely does not end on April 2nd.
Yeah, so this could be months or years of that. How much damage does that cost?
Well, at some point, people will move on from the conversation when eggs are not $12 a dozen. I think but that's an important point. Again, we've already seen multiple delays to multiple parts of this conversation. Why can't I continue to have multiple more delays? Again, I understand the difficulty that this conversation has for the consumer and for the economy. I'm just simply saying, I don't think these worst case outcomes are coming to pass.
Over at Solis, are you leaning into some of the pro-growth trades then, betting that people have gotten a little over their skis with this severe downturn in growth that on the margins is slowly getting priced in?
That's not exactly what we do. What I would say is we have been long energy and have remained long energy. We have faded the idea that global growth is going to somehow suffer in a meaningful way to impact energy demand in a meaningful way. And obviously, at least this year, that's proven to be a pretty good trade, energy being the best performer in the S&P 500. And we still have a couple of consumer-related trades that have held up well. And again, we talk about this every morning, what these companies have to say. I come back and I report, this company said X, this company said Y. Obviously, we're aware of what the home builders had to say. And I don't mean to suggest that EPS estimates haven't come down for basically every retailer. They have. But again, when you listen to some of these comments, Dick's Sporting Goods, when asked about this, said absolutely not in terms of a change in consumer behavior. Now, that wasn't yesterday, it was a couple of weeks ago, but still, you're still seeing a consumer that's doing okay. And I don't believe the administration is willing to push this all the way into a recessionary environment, even if your goal is to reshore steel manufacturing and bring shoe construction back on shore. I'm not sure they're willing to risk a recession for that.
Just to build on that, there's something almost unbelievable about the consumer sentiment data of the last 24 hours. To see it below the levels of where we were back in 2022, when inflation was approaching double digits and federal interest rate hikes.
But let me interrupt for one quick second.
Please do.
The counter to that, as Anne-Marie surely knows, right track, wrong track is doing very well. When you poll people about the administration's policies,
they like them.
They like them. And again, the right track is the highest since 2009, and before that, 2002, something like that. clearly something is, at least in the short term, and a lot of this has to do with dissatisfaction with the previous administration, but clearly a chunk of the country thinks things are going well. There's worries about the impact of inflation and what that's going to do to my purchasing power. We're in a much higher inflation environment now than we were during the first administration. But again, if you start to get meaningful price hikes such that bulldozers are pulling up to the Federal Reserve, I imagine you're going to get a change in policy.
I think there's been some notable developments over the last few days, not just from the President and the White House, but from the Treasury as well. Listening to Secretary Bessent over the weekend speaking to the All In podcast, making the case that actually you should pay attention to the sentiment surveys because the previous administration were gaslighting the public. I think that tells you they are taking things more seriously than
100%.
maybe we were led on to believe by the administration themselves over the past few weeks.
I would agree with that, which is the reason why there's been this real shift in tone. What they're willing to do with that, though, is another question, especially given that they do want to announce something pretty significant on April 2nd, and they're dueling entities within the White House, and that, I think, is what we're trying to get a handle on.
Dan, you're going to stick with us, I'm pleased to say. Dan Greenhouse there of Solace Alternative.
2 segments.
Asset Management, a whole 2 segments. Bonus round. Let's get you an update on stories elsewhere this morning. This is your Bloomberg Brief where you have to be quiet for a couple of minutes, all right? Going to be okay? Canada and India looking to resolve tensions and strengthen trade ties to counter US tariffs. Sources telling us here at Bloomberg both nations are considering sending back envoys after expulsions. And a meeting between Prime Minister Mark Carney and Indian PM Modi is possible at the G7. President Trump is backing his National Security Advisor Michael Waltz as the administration investigates a chat leak. Waltz taking responsibility for the breach after an Atlantic editor was added to a Signal group chat discussing military strikes in Yemen. And finally, 23andMe users scrambling to delete their genetic data saw technical problems due to a flood of website traffic. While some users were successful, others were locked out of their accounts. This last line is scary. Genetic information will be part of the company's bankruptcy auction in May.
That's almost disgusting as part of scary.
Goodness me. That is your Bloomberg Brief. Up next on the program, Trump's tax plan coming together.
There's no daylight between House and Senate Republicans. We are one team. We have to bring stability to the markets. We've got to make sure everybody's tax rates are locked in, and they know that. I have been pressing very hard, very aggressively to get the reconciliation bill done by late spring.
That conversation up next. We'll head down to the nation's capital and catch up with Bloomberg's Tyler Kendall from Washington, D.C. From New York City this morning, good morning.
On the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Equity futures just about unchanged following a 3-day run of gains on the S&P 500. We are negative elsewhere, down about 0.1% on the Nasdaq. And the negative mood still on some parts of Wall Street. Barclays cutting its target on the S&P 500 for year-end 25 to 5,900 from 6,600. The base case assumes that earnings will take a hit as tariffs contribute to a material slowing in US activity. They're keen to point out we will avoid recession, but a hit to activity nonetheless. Equities down just a little bit softer across the board. Under surveillance this morning, Trump's tax plan coming together.
There's no daylight between House and Senate Republicans. We are one team. We're all united on the mission. I don't fault the Senate. Like, the timing is very important because we have to bring stability to the markets. We've got to make sure everybody's tax rates are locked in, and they know that. I have been pressing very hard, very aggressively to get the reconciliation bill done by late spring.
So here's the latest this morning. Republican leaders nearing a plan to extend Trump's 2017 tax cuts and lift the debt ceiling. This ahead of the Senate's goal to pass a budget resolution by the week of April 7 to outline the cuts. Bloomberg's Tyler Kendall joins us now for more. Tyler, what is the timeline? How long is this going to take?
Well, John, we have to put some cautious optimism in this, that there is still deep divisions, particularly among those top-line numbers when it comes to where lawmakers are going to do those spending cuts and those tax cuts, and that could impact the timeline here. You mentioned Leader Thune has outlined that he would like to see his chamber pass that budget resolution by the week of April 7th, potentially teeing up a broader vote on the package by Memorial Day, but that is considered to be a very ambitious timeline, although it's no surprise where that pressure is likely coming from, particularly from where I'm standing, since we know this White House would like to get more cash into consumers' pockets and quickly in order to offset those tariff uncertainty concerns. Now, when it comes to exactly what they need to do going forward, perhaps the most optimistic point that House Speaker Mike Johnson made was that it appears that his Senate counterpart, Leader Thune, is coming around on the idea of increasing the debt limit as part of this package. We know that was a big sticking point here, but those top-line numbers still need a lot of negotiations. Of course, you'll recall the potential $2 trillion in spending cuts that the House budget blueprint has floated. We know that for some Republicans, there are concerns about what that could mean for programs like Medicaid, but among other Republicans, there's concerns that that's not enough, particularly to offset a potential debt ceiling increase. And then that doesn't even begin to address the tax cuts, $4.5 trillion in planned cuts. As you well know, that's likely only enough to extend the 2017 tax cut plan, not to make it permanent, as this White House would like to see. And it doesn't even begin to address all those other tax cut priorities from the campaign trail, like no taxes on tips, overtime pay, Social Security, or lowering the corporate tax rate for those companies that move production to the U.S.
Yesterday, Tyler, we heard from Senator Ron Paul, who said they've lost me. This is an individual who's never going to vote for reconciliation if there's an increase in the debt ceiling. What are the biggest hurdles in the Senate when it comes to some of the personnel?
Right, exactly. And we have to keep in mind that this is also going through the reconciliation process, which means that Republicans need simple majorities to pass this, but that means every vote is going to end up counting. We are expecting the Congressional Budget Office later today to release their projection of the X date. There's a lot of weight put into this. So far, that projection has been put to midsummer to early fall, so we'll have to see where that shakes out and how Republican lawmakers on the Hill respond to that. The biggest focal point here is going to be whether or not they are going to enact more spending cuts in order to offset these concerns that we are seeing from lawmakers. And you asked about the Senate. I'd also point out in the House Speaker Mike Johnson really can only afford to lose one vote when it comes to this, and I already have a list of lawmakers I can think of that will likely raise some concerns here, whether that's from the House Freedom Caucus or those Republicans representing SALT districts.
Tyler, appreciate your time as always. Tyler, in front of the White House down in Washington, D.C. Let's extend the conversation, bonus round, with Dan Greenhouse of Solace Alternative Asset Management. Dan, let's continue the conversation that we picked up with Tyler just there. Is it sufficient for equity bulls just to extend current policy in a tax plan?
I think so, and we've talked about this in the past. I don't think a lot of the other stuff gets passed. No tax on tips is $100 billion. No tax on overtime is $750 billion. No tax on Social Security benefits obviously is going to disproportionately affect higher income earners, so I think there's going to be some political pushback to that. So I always felt like this was already very expensive, and so adding some Christmas tree stuff to it was probably going to make it a bridge too far. So I think just an extension is more than sufficient if the economy is holding up and the job market's holding up.
But isn't that already priced in?
I think the assumption is that the extension is the minimum that you can expect. That's right. I think that's my base case. But yes, if you're the market, anything less than a complete extension would be a shock.
Well, we were talking to Libby Cantrell of PIMCO yesterday, and she talked about steamed vegetables, the tariffs, and then the excitement, tax cuts being the Sunday. But you already have the Sunday. It's priced in. It's the extension of TCJA. So now you're dealing with a composition of policies where it's skewed towards the negative.
Yeah, this is the big problem that we have in the current administration. Unlike the first administration, where I guess we'll call it the candy came first, the tax cuts and the cauliflower or whatever came, although I do like cauliflower, came later.
This has been the debate at the moment, you know, whether we should call it the vegetables or not. But carry on,
Lisa likes
please.
vegetables, too.
What do you say? I eat cauliflower for dinner. Just a head of cauliflower roasted, a little bit of salt.
This took a turn.
Put a little cherry on it. It's nice.
Which we're bringing in new viewers from the Food Network.
All right.
So yes, I mean, the inverse of the policies this time around has been a big problem for markets. But that said, is it already priced in? Yeah, probably. I've been on the other side of this debate. Everyone keeps talking about tax cuts, tax cuts. This is not tax cuts. This is just an extension of already existing policy, which on its face is not necessarily bullish for the economy or markets, other than the fact that you've reduced the uncertainty.
Right now, I'm looking also at the potential for bond markets to really pick up on some of the deficit that will be incurred from what we're expecting to see, considering that there really isn't the appetite for Medicare or Medicaid cuts as well as Social Security. At what point does that become a liability?
I don't think so. I mean, listen, if DOGE gets around to, the government itself tells us that there's hundreds of billions of dollars of fraud, waste, the magical fraud, waste, and abuse in Medicare, Medicaid, and Social Security. So I don't think you need to cut benefits, at least at the outset. You don't need to cut benefits. If you can get in there and do even a fraction of the supposed hundreds of, and listen, if the government's telling me it's 200 or 300 billion, it's probably twice that. But if you can get even some of that fraud, waste, and abuse out of the system, that's enormously beneficial from a debt issuance standpoint, from a taxation standpoint, from a, just a holistic standpoint about what you're trying to accomplish. And again, I know DOGE hasn't been met with universal acclaim thus far, but if you can get some of that fraud out of the system, that's an incredibly powerful tailwind to the efforts to sort of streamline the government.
A reason to be bullish bonds?
Treasuries?
Yeah.
Well, yes, to the extent that issuance would be meaningfully. I mean, listen, I know people who think you're talking in total $1 trillion of fraud, waste, abuse throughout the entirety of the government, whether it's defense, Medicare, Medicaid, firing parks workers who are letting people in through the gates. Like, there are people who are pretty optimistic about the level of just total wasteful government spending. And someone used the other day, someone used the phrase eye-opening with respect to the USAID stuff and how much stuff we're funding around the country, whether you agree with plays in Bolivia or condom distribution, wherever it actually might be going on. Even if you agree with that policy-wise, there are a lot of people who think, okay, given what's going on, is that really money we should be spending? And if you bring that back home, this is billions upon billions upon billions of dollars. So yes, it's a reason to be optimistic treasuries, especially in an environment where the Treasury Secretary is telling you, I want lower Treasury yields.
This story's changed so quickly. We came into 25 with 10-year yields pushing 5%. We were talking about extra supply, big tax cuts, and all of a sudden we're talking about completely the opposite and lower bond yields.
And the reason why is because of Scott Bessent and his focus on the 10-year yield. And I would say single-handedly, that's the entirety of it. Because you take off the potential extension of maturities, you take off the table the fact that they're going to just sort of increase the deficit ad nauseum because he is going to take the reins. Question is how they do that. I understand some of the discussions around fraud, et cetera, but Libby Cantrell said all of those cuts get put back into the agencies for 5 years and won't necessarily count toward deficit reduction.
Because Congress has the purse strings, and once Congress already decides to have funds, put funds towards specific programs, then the funds go back to Congress. They are the power of the purse, but maybe they could put towards other provisions and policies.
Politically, and I stress politically, I struggle to see how they go into the midterms next year, just extending current policy. The pressure to do more of that is going to ramp up over the next few months for sure. Dan Greenhouse of Solis Alternative Asset Management. Dan, good to see you, sir, as always. Up next, Chris Marr of Ocean First Bank on the impact of tariffs on small business. From New York, this is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Equities just about unchanged here on the S&P 500. We have had a change, though, on Wall Street. A couple of changes in the last 24 hours. HSBC and Max Kettner downgrading equities to underweight, U.S. equities. And then Venu Krishna out of Barclays cutting his price target on the S&P 500 from 6,600 to 5,900 off the back of the tariff changes we've seen and the earnings hit that he anticipates. Equities down on the Nasdaq by about 1/10%. Should we get you some movers? Let's do that now. Your morning movers with Danny Berger. Hey, Danny.
Hey, John. Happy to bring them to you. Tesla down this morning, more than 1% the pre-market. Look, it could just be because this stock has been on a 5-day winning streak. But interesting moves coming out of Canada yesterday. The government announcing that Tesla would no longer be eligible for EV rebates. Any rebates currently in the system will be frozen. They're directly tying this to tariffs, saying that Elon Musk company won't be eligible for them until they end what Canada calls the illegal and illegitimate tariffs placed onto them. Now, a kind of similar story when it comes to governments potentially using companies as fodder in the trade war. This coming from China on NVIDIA. NVIDIA shares down 1.5% in the pre-market. The FT reporting that they have environmental rules that would prohibit the use of NVIDIA chips that are eligible to be sold in China. Now, these are just rules. It's not clear how strictly this ban will be enforced, but if it is, it will remove a huge market for NVIDIA. Finally, wrapping things up with some earnings. We had Dollar Tree out about an hour ago. They did miss, but you'll notice that shares are higher, and that is because of a journal story, higher by about 4%, I should say. A journal story saying that they are looking at selling one of their businesses, Family Dollar, for about $1 billion. They're in the midst of a turnaround. A lot of competition has been weighing on them, so investors liking that one, John.
Danny, thank you. The stock is higher by close to 4%. Let's get you some top stories. On our radar this morning, Republican leaders saying they're close to agreeing on a plan to extend President Trump's 2017 tax cuts and increase the debt ceiling. House Speaker Mike Johnson saying his Senate counterparts are, quote, coming around.
So they're singing from the same tune when it comes to reconciliation, potentially getting this track on schedule. What I find so interesting is now that the debt ceiling can be potentially roped into reconciliation, it means that they have a pretty firm deadline. It has to be done, even though the House is talking about Memorial Day. Everyone thinks that's very, very quick and almost too fast, but it has to be done by the middle of the summer or at least by September if you're going to include the debt ceiling in it. And this is getting a lot of wins from the White House. This is what President Trump wants to see. So potentially there's going to be a ton of hurdles they need to get through with individual senators or congressmen and women that they need to get on board. But the timeline could be by September that they will have a deal in place to extend TCJA.
And the baseline is that this deal would increase the deficit by $3 trillion over the next decade and includes about $2 trillion of offsetting cost-cutting measures, including to Medicaid and to Social Security, which is something that a couple of senators cannot get on board with. How do they reconcile this? Does it come at the expense of a deficit, and will the bond market perk up, or will it come at expense of the popularity of a number of different representatives?
If this moves quickly, I think we'd all be pleasantly surprised. I'm not sure how many people actually think it will.
I think it's going to be months, not weeks. I mean, they're thinking maybe the end of May. That seems incredibly fast. At the same time, though, you do see the Treasury Secretary really focused on this. He's had a number of meetings, whether it's the Treasury Department going up on the Hill, getting this group together, and making sure they get this over the finish line. And then, of course, you're going to have the chief whip coming from the White House. President Trump is going to make calls himself, I imagine, to get this over the finish line.
Let's get you an update on cost cuts as well. The Treasury planning to lay off a, quote, substantial number of employees as part of Elon Musk's Doge cost-cutting efforts. A spokesperson saying the department is looking at efficiency measures and reversing some Biden hiring decisions.
Look, we don't have a sense of exactly who these people are. And before we really come out with judgment, just to put into perspective, the Treasury has more than 100,000 employees across a number of different agencies, including the IRS, the Bureau of the Fiscal Service, the U.S. Mint, and the Office of the Comptroller of the Currency. So there are a lot of areas that they could potentially be cutting. The key question is, and we keep talking about this, is there a plan? Is there something that is systematic to go through and do it with diligence and actually cut the right people? And I think, we just don't know.
There's certainly a cost associated with some of these cuts. Take a listen to this. China, replacing funding for 2 former USAID projects in Cambodia, cancelled by the Trump administration, totaling $40 million. The State Department saying the U.S. is focusing on funding aid programs that make Americans wealthier and more secure. There is a cost, and it's not financial. It's influence.
It's about soft power and who is going to immediately step in and already stepping in to fill that void. And of course, it's China. And what we're talking about with these programs that were happening in Cambodia, this is about child literacy. And this is about nutrition, improving nutrition and development of children under the age of 5. You have to ask yourself, is this consistent with a very tough policy stance when it comes to China, when you're ceding some territory in terms of influence to Beijing?
This just shows the need for nuance. You can say that there are a lot of programs that should be cut that maybe don't necessarily engage with soft power for the United States. There are other programs that are very important, and that is sort of the question around, is there some sort of accountability and a sense of method to exactly where these cuts will be executed?
That's the opportunity right now in Washington, I think, for the Democrats to make the argument that you've just made. Instead of having a wholesale opposition to what they're doing, say, yes, you're right. This is where taxpayer money shouldn't go. And you'd find agreement with the taxpayers right now. You see that in the surveys. But then you can also point out, well, this is also areas where it needs to go, and this is why. Because if you want to counter China, this is what you need to do. And here's a real example of that happening in real time.
And you can see it around the world. China's trying to fill that void in a number of different places. Of course, the Democrats are so beset with internal disagreement that they can't come up with some sort of main argument about whether to go hard against the Republicans or whether to take a more moderate negotiating stance. So, maybe they should, but they probably...
You know how this works. The rule book for Democrats right now, everything the orange man does is bad. Okay?
Yeah, so, that seems to be the tone.
Let's turn to tariffs. Ocean First Financial CEO Chris Mars saying, while the direct impact on businesses isn't concerning at present, the volatility and uncertainty is clearly evident. The longer the period of uncertainty, the more likely the perceptions translate into reality. Chris joins us now for more. Chris, good morning.
Good morning, John.
It's been too long. It's good to see you again, sir. Let's start with the reality, your reality in your business at the moment. What do you see?
It's interesting because we'll read about tariffs. Our clients are not particularly concerned about them. And I think you have to look from their perspective. They've been through the first Trump administration. And they have been through COVID. So, I like to say our folks got a PhD in supply chains during COVID. They figured out, I have remarkably small businesses that bank with us. We cover clients between Boston and Washington. I have a pet foods business. This guy can explain to you the supply chains in China, Cambodia, Vietnam. He understands the tariffs. He knows where he's going to get his stuff, and it is not looming large in their minds. So it's more the perception than the reality.
It's her sentiment. We see it in the survey at a consumer level. We're having this debate about whether it's hurting activity. So these companies that came into the new year with investment plans, with hiring plans, are they on hold or are they going forward with them?
They're on hold. They're a little bit cautious and concerned. They want to make sure they see how things kind of pan out. You talked about the continuation of the tax cuts earlier, right? For those customers, these are higher income households that own these businesses. They're trying to figure out the whole puzzle. So it'll be okay for a little while. We have days, we probably have weeks, but I don't think we have months before that confidence starts to impact the economy.
I want you just to elaborate a little bit further on the point that John was making. There was an estimate of some of the small business confidence, a survey that showed just 19% of small business owners in February were planning the capital outlays in the next 6 months, which matches the lowest level since April 2020. How do you match that
with what you're telling us, that actually they're okay, they're taking it in stride. Is there a sense that they really are going to re-engage with all of those capital outlays immediately within the next 6 months as soon as there is some clarity?
You know, Lisa, I think that with these small business owners, right, the company and their own personal financials are really closely tied. So they tend to be more cautious. They've built up liquidity since kind of COVID happened. They understood the uncertainty. They have plans. We're talking about plans. Loan pipelines are improving and increasing, but there is a range of hesitancy around some of kind of the edge residential construction is an area where people are kind of holding back. They want to make sure that we don't kind of head into a recession. There isn't a demand issue down the road. So,
are they concerned about the competitive advantage that they have versus large companies, given their negotiating position with potential contractors, with potential supply chain dealers? We hear about Walmart going to China and saying, guys, lower your prices. And they can do it because they're an 800-pound gorilla. And even they're getting pushback. I mean, how much is that a real issue for your clients?
It is an issue, Lisa. It's in a very different way. So we have, I'll use the home building example. So we work with some of the largest home builders in the country. They can stock warehouses full of appliances, so they're just kind of immune to where the appliances come from. But in a different way, the small builders just move where they're buying stuff from. So, you know, GE Appliances has a pretty strong U.S. domestic manufacturing base. So they're going to buy GE instead of some other brands. Some of the other brands have a bigger base in, say, Canada. So the small businesses are more nimble. The big businesses are able to do kind of more bold supply chain things, stocking up inventories and kind of planning ahead.
Are materials going up? Are they already seeing those price effects?
Sure, Emery. They've gone up. Lumber's gone up 3 different price hikes in the last couple of months. So lumber's certainly up. You're seeing anything with steel or aluminum. Although I'd make the comment that we tend to talk about steel. For our clients, there's like 50 different kinds of steel. Some steel is going to be an issue. Other kinds of steel are not. And although we're talking with many international parties, steel can be sourced from South Korea, can be sourced from Latin America. So there's a very interesting kind of subset as you get under the covers and look. For one company, steel may matter. For another company, it doesn't.
I was speaking to the head of a toy manufacturer, and he was saying, well, it's not that big of a deal because we can kick up prices. And if people are buying a doll, they can pay an extra $2 and they don't really care. Do your business clients feel the same way, that they can really pass it mostly along to clients?
Generally, no. They're very concerned about passing it along. Although we're starting to see contracts now have language in the contract that would say, you know, we're going to pass along the price increases. So generally, no. There are some cases that we have a special metal manufacturer. Their products go into jet engine turbines. We need them. So yes, the price is going to go up. It'll be a small increase to a bigger part of a larger engine. So they're just going to have to raise prices.
But this is where the rubber meets the road. They increase prices. Are you hearing direct feedback that consumers are unwilling to absorb those higher prices?
I think in consumer products, you're seeing substitution. So people are choosing one thing versus another thing. We have a seafood supplier. They get snow crabs, right? So they get them from Canada. They have already told us if the tariffs go in, they're not going to sell snow crabs. You'll be eating something else. So you won't notice that your menu has changed, but the snow crabs won't be on it because they're just going to go up to a price that, you know, restaurateurs are not going to want to buy.
Hey, Chris, this was an important conversation. Let's do it again soon.
All right, John.
Chris Marr of Ocean First Bank. Really some clarity there as to what's happening on the ground in reality, not just the sentiment surveys, but what people are actually doing and not doing.
They might be conservative with their own finances, but they're not, you know, losing their minds. They're not saying, okay, this is it, we're going to close our business and we're really going to suffer some sort of recession, which indicates really what people in markets are looking through. They're saying, okay, sentiment's bad, but we can all rant online. It doesn't mean that we're going to go into recession.
There's a difference between hiring, pausing, and firing. And at the moment, we're somewhere in between, pausing. I hope we flip back to hiring. All that confidence we came into 2025 with, I hope we get back to that place. The next stop for this conversation, really, once we get through jobless claims tomorrow morning, payrolls next Friday. If you want a sneak peek right now in our survey, 151,000 a previous number, 120 is the median at the moment. Only a handful of guesses so far, but 120 is the median estimate at the moment.
The difficulty is if you get a number that goes one way or another, if it is a downside surprise, it will have a material effect. If it is an upside surprise, then people will get the sense that there is still a momentum, but it won't clarify the uncertainty. Key question for me is this, and Chris was addressing this and other guests have as well. It is a months or years kind of thing. If it's a couple weeks, it's not a big deal. A month, we can get through it. 2 months, 3 months, it starts to change.
Max Kettner, HSBC, thinks it's too late already. That's just one view. That's his view. Equities right now on the S&P 500, just about positive. We're basically unchanged this morning. Let's get you an update on stories elsewhere. Here is your Bloomberg Brief. Vice President J.D. Vance and his wife, Usha, revising their Greenland travel plans as a U.S. envoy travels to the territory later this week. The Vances will no longer visit more populous areas, instead traveling to an isolated U.S. military base. Elsewhere, oil edging higher, as an American Petroleum Institute report shows a large decline in U.S. crude stockpiles. The market also weighing a Russia-Ukraine ceasefire in the Black Sea, even as the Kremlin seeks sanctions relief and other preconditions. And finally, Wall Street bonuses surging in 2024. The total payout pool jumping to a record $47.5 billion, the largest on record since 1987. The average annual bonus rising by almost a third to just over $244,000. That's not bad, Bramo.
I would agree with that, and I wonder how much that's going to single-handedly lift the New York City economy. I was actually looking at the data, and you could see that the pop was entirely from that. So you have to imagine.
What would be even better for some of these Wall Street bonuses if there was no tax on tips? You consider that a tip?
Are we going to consider that a tip?
You could. That's where the legislation gets difficult.
Let's see if they even make that push to try and get those taxes on tips removed, because from what we've heard over the last few months, maybe that's going to be pared back.
Yeah, they're throwing a lot of cold water on that. Most people just expect an extension of TCJ. I'm just saying, if you were to have no tax on tip, you have to then outline what is a tip. And a bonus, for many people, would be considered a tip.
That right there is your Bloomberg Brief. Up next on the program, falling consumer confidence.
We've seen a really large and pronounced pullback in both business and consumer confidence.
It's a state where it's not as robust as it had been, and consumers are discerning.
Up next on the program, the team behind the survey, Yelena Shulacheva of the Conference Board from New York City. This is Bloomberg.
In case you missed it, on Bloomberg Crypto.
You have sell-side analysts taking a look at what you're doing and starting to compare you to Coinbase. Are you after their business?
Well, I think we compete in the general sense of offering crypto to customers, but also this is a nascent industry and not very many companies have entered yet. Even though Bitcoin has now been around for 15 years, institutions and other companies have been waiting for signals to enter the market.
There are a lot of financial firms that are looking to tokenize private funds also.
Yeah.
Are you in talks with any of them?
We're generally in conversations with anyone trying to do interesting things in the space. If I had to pick the biggest pain point, AI is like transforming everything. So I think it's tough right now if you want to be in the AI sector as a retail investor. There's relatively few options that you can actually invest in.
Don't miss Bloomberg Crypto live Tuesdays.
Welcome to the world of decentralized finance.
Massive